Welcome to Wealth Mastery, a comprehensive guide to achieving financial independence, your essential roadmap to navigating the complexities of personal finance with confidence and clarity. Written and published by Mindful Literary, this book is designed to empower you with the knowledge, strategies, and insights needed to take control of your financial future. In a world where financial literacy is as crucial as ever, we've crafted this guide to demystify the intricacies of managing money, investing wisely, and building a secure financial foundation. Whether you're starting from scratch or looking to elevate your financial savvy, Wealth Mastery offers a structured approach to achieving financial independence. As we embark on this journey together, we invite you to engage with each chapter actively, reflect on your financial habits, and apply the principles and strategies discussed. Remember, the path to financial freedom is unique for everyone, but the core principles of personal finance are universal. And now, let us dive into the first chapter, Understanding Personal Finance. Introduction to Personal Finance. Personal finance is the management of an individual's financial resources, including income, expenses, savings, investments, and debt. It is a crucial aspect of our lives that affects our ability to achieve financial independence and live a comfortable and secure life. In this chapter, we will explore the fundamentals of personal finance and provide you with the knowledge and tools to take control of your financial future. We will cover various topics such as budgeting, saving, managing debt, and building an emergency fund. By understanding and implementing these principles, you will be on your way to achieving financial freedom. Importance of personal finance. Understanding personal finance is essential for everyone, regardless of their income level or financial goals. It empowers individuals to make informed decisions about their money, enabling them to achieve their financial aspirations and avoid common financial pitfalls. By gaining knowledge about personal finance, you will be able to take control of your finances. Personal finance provides you with the tools to manage your income, expenses, and investments effectively. It allows you to make informed decisions about how to allocate your resources and achieve your financial goals. Build wealth. By implementing sound financial strategies, such as budgeting, saving, and investing, you can build wealth over time. Personal finance helps you understand the various investment options available and how to make your money work for you. Prepare for emergencies. Life is unpredictable, and unexpected expenses can arise at any time. By having a solid understanding of personal finance, you can build an emergency fund to handle unforeseen circumstances without derailing your financial progress. Reduce financial stress. Financial stress can have a significant impact on your overall well-being. By managing your finances effectively, you can reduce stress and anxiety related to money matters, allowing you to focus on other aspects of your life. Plan for the future. Personal finance involves setting financial goals and creating a roadmap to achieve them. Whether it's saving for retirement, buying a home, or funding your children's education, understanding personal finance will help you plan for the future and ensure you are on track to meet your objectives. The basics of personal finance. To lay a strong foundation for your financial journey, it is essential to understand the basics of personal finance. Here are some key concepts that will be covered in this book. Budgeting and saving. Budgeting involves creating a plan for your income and expenses, ensuring that you allocate your money wisely. Saving is the process of setting aside a portion of your income for future use, whether it's for emergencies, investments, or specific financial goals. Managing debt. Debt management is crucial for maintaining a healthy financial life. This section will cover strategies for managing and reducing debt, including credit card debt, student loans, and mortgages. Building an emergency fund. An emergency fund is a financial safety net that provides you with peace of mind during unexpected events. This section will guide you on how to build and maintain an emergency fund to protect yourself from financial hardships. By mastering these fundamental concepts, you will be equipped with the knowledge and skills to make sound financial decisions and pave the way towards financial independence. In the next section, we will delve deeper into budgeting and saving, exploring strategies to effectively manage your income and expenses. Let's begin our journey towards financial freedom. Budgeting and saving. Budgeting and saving are essential components of personal finance that play a crucial role in achieving financial independence. By effectively managing your income and expenses, you can take control of your financial situation and work towards your long-term goals. In this section, we will explore the importance of budgeting, the steps involved in creating a budget, and strategies for saving money. The importance of budgeting. Budgeting is the process of creating a plan for how you will allocate your income to cover your expenses and save for the future. It provides a clear picture of your financial situation and helps you make informed decisions about your spending habits. Here are some key reasons why budgeting is important. Financial awareness. Budgeting allows you to track your income and expenses, giving you a clear understanding of where your money is going. It helps you identify areas where you can cut back on unnecessary expenses and make adjustments to achieve your financial goals. Debt management. By creating a budget, you can allocate a portion of your income towards paying off debts. This helps you stay on track with your debt repayment plan and avoid accumulating more debt. Savings and investments. Budgeting enables you to set aside money for savings and investments. Whether it's building an emergency fund, saving for a down payment on a house, or investing for retirement, budgeting ensures that you prioritize your financial goals. Financial stability. A well-planned budget provides stability and peace of mind. It helps you avoid living paycheck to paycheck and prepares you for unexpected expenses or financial emergencies. Steps to creating a budget. Creating a budget may seem overwhelming at first, but by following a few simple steps, you can develop a budget that works for you. Here are the steps involved in creating a budget. Determine your income. Start by calculating your total monthly income. Include all sources of income, such as your salary, freelance work, rental income, or any other additional income streams. Track your expenses. Keep track of all your expenses for a month. This includes fixed expenses like rent, utilities, and loan payments, as well as variable expenses like groceries, entertainment, and dining out. Use a spreadsheet or budgeting app to record your expenses accurately. Categorize your expenses. Once you have tracked your expenses, categorize them into different groups such as housing, transportation, food, entertainment, and debt payments. This will help you identify areas where you can potentially reduce your spending. Set financial goals. Determine your short-term and long-term financial goals. These could include saving for a down payment on a house, paying off debt, or building an emergency fund. Assign a specific amount of money to each goal and prioritize them based on importance. Allocate your income. Based on your income and expenses, allocate a portion of your income towards each expense category. Start with essential expenses like housing, utilities, and debt payments, and then allocate money towards savings and discretionary spending. Monitor and adjust. Regularly review your budget to ensure that you are staying on track. Monitor your expenses and compare them to your budgeted amounts. If necessary, make adjustments to your spending habits to align with your financial goals. Strategies for saving money. Saving money is a fundamental aspect of budgeting and plays a significant role in achieving financial independence. Here are some strategies to help you save more effectively. Automate savings. Set up automatic transfers from your checking account to a separate savings account. This ensures that a portion of your income is saved before you have a chance to spend it. Reduce discretionary spending. Identify areas where you can cut back on non-essential expenses. This could include eating out less frequently, canceling unused subscriptions, or finding more affordable alternatives for entertainment. Shop smart. Compare prices, use coupons, and take advantage of sales to save money on groceries, clothing, and other purchases. Consider buying in bulk or purchasing generic brands to save even more. Energy efficiency. Reduce your utility bills by practicing energy-saving habits. Turn off lights when not in use, unplug electronics, use energy-efficient appliances, and adjust your thermostat to conserve energy. Avoid impulse buying. Before making a purchase, take some time to evaluate whether it is a necessity or a want. Avoid making impulsive purchases and give yourself a cooling-off period to determine if it aligns with your budget and financial goals. Negotiate bills and expenses. Contact service providers to negotiate lower rates on bills such as cable, internet, or insurance. Often, they are willing to offer discounts or promotions to retain your business. By implementing these strategies and making saving a priority, you can gradually build your savings and work towards achieving financial independence. In the next section, we will explore the importance of managing debt and strategies for effectively paying off debts. Managing debt. Debt is a common aspect of personal finance that many individuals face at some point in their lives. Whether it's student loans, credit card debt, or a mortgage, managing debt is crucial for achieving financial freedom. In this section, we will explore the importance of managing debt and provide you with practical steps to take control of your financial situation. Understanding debt. Before we delve into managing debt, it's essential to understand what debt is and how it can impact your financial well-being. Debt is money borrowed from a lender with the expectation of repayment, usually with interest. While debt can provide opportunities for growth and investment, it can also become a burden if not managed properly. There are two main types of debt: good debt and bad debt. Good debt is typically associated with investments that have the potential to increase in value over time, such as student loans or a mortgage. Bad debt, on the other hand, refers to debt incurred for non-essential purchases or high-interest loans, such as credit card debt or payday loans. The importance of managing debt. Managing debt is crucial for several reasons. First and foremost, excessive debt can lead to financial stress and negatively impact your overall well-being. It can limit your ability to save, invest, and achieve your financial goals. Additionally, high levels of debt can result in a poor credit score, making it challenging to secure loans or obtain favorable interest rates in the future. By effectively managing your debt, you can take control of your financial situation and work towards achieving financial independence. It allows you to allocate more of your income towards savings and investments, rather than paying off interest and fees. Moreover, managing debt responsibly demonstrates financial discipline and can improve your creditworthiness over time. Steps to managing debt. Now that we understand the importance of managing debt, let's explore some practical steps you can take to regain control of your financial situation. 1. Create a debt repayment plan. The first step in managing debt is to create a debt repayment plan. Start by listing all your debts, including the outstanding balance, interest rate, and minimum monthly payment. Prioritize your debts based on interest rates, focusing on paying off high-interest debt first. Consider using the debt snowball or debt avalanche method to accelerate your debt repayment. 2. Reduce unnecessary expenses. To free up more money for debt repayment, it's crucial to reduce unnecessary expenses. Review your monthly budget and identify areas where you can cut back. This might involve making sacrifices in your lifestyle, such as dining out less frequently or canceling unused subscriptions. Redirect the money saved towards paying off your debts. 3. Negotiate lower interest rates. High interest rates can significantly increase the cost of your debt. Consider negotiating with your lenders to lower the interest rates on your loans. This can be particularly effective if you have a good credit score and a history of on-time payments. Lower interest rates can save you money in the long run and help you pay off your debts faster. 4. Consolidate and refinance. If you have multiple debts with high interest rates, consolidating them into a single loan with a lower interest rate can be a smart move. Debt consolidation allows you to simplify your payments and potentially save money on interest. Similarly, refinancing your mortgage or student loans can help you secure a lower interest rate, reducing your monthly payments. 5. Seek professional help if needed. If you find yourself overwhelmed by debt or struggling to make progress, don't hesitate to seek professional help. Credit counseling agencies and financial advisors can provide guidance and support in managing your debt. They can help you create a personalized debt repayment plan and negotiate with your creditors on your behalf. 6. Avoid taking on new debt. While you're working towards paying off your existing debt, it's crucial to avoid taking on new debt. This means resisting the temptation to use credit cards for unnecessary purchases and carefully considering any new loans or financing options. Focus on living within your means and prioritize saving and investing over acquiring new debt. Celebrate your progress. Managing debt is a journey that requires patience and discipline. As you make progress in paying off your debts, take the time to celebrate your achievements. Each milestone reached brings you one step closer to financial freedom. Use these small victories as motivation to stay on track and continue making smart financial decisions. By effectively managing your debt, you can pave the way for a brighter financial future. It's not always easy, but with determination and a solid plan, you can overcome your debts and achieve financial independence. Remember, managing debt is a crucial step towards building a strong financial foundation and creating a path to long-term wealth. Building an emergency fund. An emergency fund is a crucial component of any solid financial plan. It acts as a safety net, providing you with a financial cushion in case of unexpected expenses or emergencies. Building an emergency fund should be one of your top priorities on your path to financial freedom. In this section, we will discuss the importance of an emergency fund, how much you should save, and strategies to build and maintain it. The importance of an emergency fund. Life is full of uncertainties, and unexpected events can occur at any time. Whether it's a medical emergency, a car repair, or a sudden job loss, having an emergency fund can help you navigate these situations without derailing your financial progress. Without an emergency fund, you may be forced to rely on credit cards or loans, which can lead to debt and financial stress. An emergency fund provides you with a sense of security and peace of mind. It allows you to handle unexpected expenses without disrupting your regular budget or dipping into your long-term savings. By having a financial safety net, you can avoid going into debt and maintain control over your financial situation. How much should you save? The amount you should save in your emergency fund depends on your individual circumstances and financial goals. As a general rule of thumb, it is recommended to have at least 3 to 6 months' worth of living expenses saved in your emergency fund. This includes essential expenses such as rent or mortgage payments, utilities, groceries, transportation, and insurance. However, the ideal amount may vary based on factors such as job stability, income level, and the number of dependents you have. If you have a stable job with a steady income, you may lean towards the lower end of the range. On the other hand, if you have irregular income or dependents, you may want to aim for a larger emergency fund to provide a greater safety net. It's important to assess your personal situation and determine the amount that makes you feel secure. Consider factors such as your monthly expenses, the stability of your income, and any potential risks or uncertainties in your life. Remember, the goal is to have enough saved to cover your essential expenses for a few months in case of an emergency. Strategies to build an emergency fund. Building an emergency fund requires discipline and commitment. Here are some strategies to help you save and grow your emergency fund. Set a savings goal, determine how much you want to save and set a specific target. Having a clear goal will motivate you to save consistently. Create a budget, review your income and expenses to identify areas where you can cut back and save more. Allocate a portion of your income specifically for your emergency fund. Automate your savings, set up an automatic transfer from your checking account to your emergency fund. This way, a portion of your income will be saved before you have a chance to spend it. Reduce unnecessary expenses, cut back on non-essential expenses such as dining out, entertainment, or impulse purchases. Redirect the money saved towards your emergency fund. Increase your income, look for ways to increase your income, such as taking on a side gig or freelancing. The extra income can be directed towards your emergency fund. Save windfalls. If you receive unexpected money, such as a tax refund or a bonus, resist the temptation to splurge. Instead, put it directly into your emergency fund. Avoid unnecessary debt, minimize the use of credit cards or loans for non-essential purchases. By avoiding unnecessary debt, you can free up more money to save for emergencies. Replenish your fund. If you need to use your emergency fund, make it a priority to replenish it as soon as possible. Resume your regular savings contributions until your fund is fully restored. Maintaining your emergency fund. Once you have built your emergency fund, it's important to maintain it over time. Here are some tips to ensure your fund remains intact. Regularly review and adjust. Periodically review your expenses and adjust your savings contributions if necessary. As your income or expenses change, you may need to increase or decrease the amount you save. Protect your fund. Keep your emergency fund separate from your regular checking account to avoid accidentally spending it. Consider opening a separate savings account specifically for your emergency fund. Avoid temptation. Resist the urge to dip into your emergency fund for non-emergency expenses. Remember, it's there to provide financial security during unexpected situations. Reassess your needs. As your life circumstances change, reassess the amount you need in your emergency fund. For example, if you have dependents or experience a decrease in income, you may need to increase your savings target. By following these steps and making building and maintaining an emergency fund a priority, you are taking a significant step towards financial independence. An emergency fund provides you with the peace of mind and financial security to handle unexpected events without derailing your progress towards your long-term financial goals. Chapter 2. Investing Basics. Introduction to Investing. Investing is a crucial aspect of personal finance that can help you achieve your financial goals and secure your future. It involves putting your money into various assets with the expectation of earning a return or profit over time. While investing may seem intimidating or complex, it is an essential tool for building wealth and achieving financial independence. Why invest? Investing allows you to grow your wealth and make your money work for you. By investing, you have the potential to earn returns that can outpace inflation and increase your purchasing power over time. It provides an opportunity to generate passive income, diversify your financial portfolio, and build long-term wealth. The power of compound interest. One of the key concepts in investing is compound interest. Compound interest is the interest earned on both the initial investment and the accumulated interest from previous periods. Over time, compound interest can significantly boost your investment returns. The earlier you start investing, the more time your investments have to grow and benefit from the power of compounding. Setting investment goals. Before you start investing, it is important to define your investment goals. Your goals will guide your investment decisions and help you determine the appropriate investment strategies. Some common investment goals include wealth accumulation, investing to build a substantial amount of wealth over the long term. Retirement planning, investing to ensure a comfortable retirement by building a retirement nest egg. Education funding, investing to save for your children's education expenses. Short-term goals, investing to achieve specific short-term financial objectives, such as buying a house or going on a vacation. By setting clear investment goals, you can align your investment strategy with your financial aspirations and make informed decisions. Risk and return. Investing involves taking on a certain level of risk. Different investment options carry varying degrees of risk, and it is important to understand the relationship between risk and return. Generally, investments with higher potential returns also come with higher levels of risk. It is crucial to assess your risk tolerance and choose investments that align with your comfort level. Types of investments. There are various types of investments available, each with its own characteristics and potential returns. Some common investment options include stocks, investing in individual company stocks, which represent ownership in a company and offer the potential for capital appreciation and dividends. Bonds, purchasing bonds, which are debt securities issued by governments or corporations, and earning interest income over a specified period. Mutual funds, investing in professionally managed funds that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. Exchange-traded funds, ETFs. Similar to mutual funds, ETFs are investment funds that trade on stock exchanges and offer diversification across various asset classes. Real estate, investing in properties or real estate investment trusts, REITs, to generate rental income or capital appreciation. Commodities, investing in physical goods such as gold, oil, or agricultural products to benefit from price fluctuations. Each investment option has its own risk and return profile, and it is important to conduct thorough research and seek professional advice before making investment decisions. Diversification and asset allocation. Diversification is a risk management strategy that involves spreading your investments across different asset classes, sectors, and geographic regions. By diversifying your portfolio, you can reduce the impact of any single investment's performance on your overall portfolio. Asset allocation refers to the distribution of your investments among different asset classes, such as stocks, bonds, and cash. A well-diversified portfolio can help mitigate risk and potentially enhance returns. It is important to regularly review and rebalance your portfolio to ensure it aligns with your investment goals and risk tolerance. Investing for the long term. Investing is a long-term endeavor that requires patience, discipline, and a focus on your financial goals. It is important to avoid making impulsive investment decisions based on short-term market fluctuations. Instead, adopt a long-term perspective and stay committed to your investment strategy. Remember, investing is not a get-rich-quick scheme. It requires consistent contributions, regular monitoring, and periodic adjustments to stay on track. By investing wisely and staying committed to your financial plan, you can pave the way to financial independence and achieve your long-term financial goals. Types of investments. Investing is a crucial aspect of personal finance that can help you grow your wealth and achieve financial independence. When it comes to investing, there are various types of investments available, each with its own characteristics and potential returns. In this section, we will explore some of the most common types of investments and their key features. Stocks. Stocks, also known as equities, represent ownership in a company. When you buy stocks, you become a shareholder and have a claim on the company's assets and earnings. Stocks offer the potential for high returns but also come with a higher level of risk. The value of stocks can fluctuate significantly based on market conditions and the performance of the company. There are two main types of stocks: common stocks and preferred stocks. Common stocks give shareholders voting rights and the opportunity to receive dividends. Preferred stocks, on the other hand, provide shareholders with a fixed dividend payment but usually do not offer voting rights. Investing in individual stocks requires careful research and analysis to identify companies with strong growth potential. Alternatively, you can invest in mutual funds or exchange-traded funds, ETFs, that pool money from multiple investors to invest in a diversified portfolio of stocks. Bonds. Bonds are debt instruments issued by governments, municipalities, and corporations to raise capital. When you invest in bonds, you are essentially lending money to the issuer in exchange for regular interest payments and the return of the principal amount at maturity. Bonds are generally considered less risky than stocks and provide a fixed income stream. There are different types of bonds, including government bonds, corporate bonds, municipal bonds, and treasury bonds. Government bonds are considered the safest as they are backed by the government's ability to tax and print money. Corporate bonds carry a higher level of risk but offer higher yields. Municipal bonds are issued by local governments to fund public projects and are generally exempt from federal taxes. Investing in bonds can provide stability to your investment portfolio and generate a steady income stream. However, it's important to consider factors such as interest rate changes, credit ratings, and the issuer's financial health when investing in bonds. Mutual funds. Mutual funds are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. They are managed by professional fund managers who make investment decisions on behalf of the investors. Mutual funds offer a convenient way for individual investors to access a diversified portfolio without the need for extensive research and analysis. There are different types of mutual funds, including equity funds, bond funds, balanced funds, and index funds. Equity funds invest primarily in stocks, bond funds focus on bonds, balanced funds hold a mix of stocks and bonds, and index funds aim to replicate the performance of a specific market index. Investing in mutual funds allows you to benefit from professional management and diversification. However, it's important to consider factors such as fees, performance history, and the fund manager's track record when selecting mutual funds. Real estate. Real estate investments involve purchasing properties with the aim of generating income or capital appreciation. Real estate can include residential properties, commercial properties, and land. Investing in real estate can provide a steady income stream through rental income and potential tax advantages. There are different ways to invest in real estate, including direct ownership, real estate investment trusts, REITs, and real estate crowdfunding platforms. Direct ownership involves purchasing properties and managing them yourself or hiring a property management company. REITs are companies that own and manage income-generating real estate properties and distribute the income to shareholders. Real estate crowdfunding platforms allow individual investors to pool their money to invest in real estate projects. Real estate investments can offer long-term appreciation and diversification to your investment portfolio. However, they require careful research, due diligence, and an understanding of the local real estate market. Commodities. Commodities are raw materials or primary agricultural products that can be bought and sold in the market. Common commodities include gold, silver, oil, natural gas, wheat, corn, and coffee. Investing in commodities can provide a hedge against inflation and diversification. There are different ways to invest in commodities, including buying physical commodities, investing in commodity futures contracts, or investing in commodity-focused mutual funds or ETFs. Physical commodities require storage and maintenance, while futures contracts involve buying or selling commodities at a predetermined price and date. Commodity-focused mutual funds and ETFs invest in a diversified portfolio of commodities. Investing in commodities can be volatile and subject to price fluctuations based on supply and demand factors. It's important to understand the dynamics of the commodity market and consider the risks involved before investing. Certificates of Deposit, CDS. Certificates of Deposit, CDS, are time deposits offered by banks and credit unions. When you invest in a CD, you agree to keep your money deposited for a specific period of time, known as the term, in exchange for a fixed interest rate. CDS are considered low-risk investments as they are insured by the Federal Deposit Insurance Corporation, FDIC, up to certain limits. CDS offer a predictable return and can be a suitable option for short-term savings goals or as a part of a conservative investment strategy. However, they typically offer lower returns compared to other investment options. Exchange-traded funds, ETFs. Exchange-traded funds, ETFs, are investment funds that trade on stock exchanges, similar to individual stocks. ETFs are designed to track the performance of a specific index, sector, commodity, or asset class. They offer diversification and flexibility, allowing investors to gain exposure to a wide range of assets with a single investment. ETFs can be passively managed, meaning they aim to replicate the performance of a specific index, or actively managed, where a fund manager makes investment decisions. They can invest in stocks, bonds, commodities, or other assets. Investing in ETFs provides liquidity, transparency, and the ability to trade throughout the day. They can be a cost-effective way to gain exposure to different asset classes and sectors. Options and futures. Options and futures are derivative contracts that derive their value from an underlying asset, such as stocks, bonds, commodities, or currencies. These investment instruments allow investors to speculate on the future price movements of the underlying asset or hedge against potential losses. Options give the holder the right, but not the obligation, to buy or sell the underlying asset at a predetermined price within a specific time period. Futures contracts, on the other hand, obligate the buyer to purchase the underlying asset or the seller to sell the asset at a predetermined price and date. Options and futures trading can be complex and involve a higher level of risk compared to other investment options. They require a good understanding of the market and careful consideration of the potential risks and rewards. Cryptocurrencies. Cryptocurrencies, such as Bitcoin and Ethereum, are digital or virtual currencies that use cryptography for security. They operate on decentralized networks called blockchain, which allows for secure and transparent transactions. Cryptocurrencies have gained popularity as an investment option due to their potential for high returns and the underlying technology's disruptive potential. Investing in cryptocurrencies carries a high level of risk due to their volatility and regulatory uncertainties. It's important to conduct thorough research, understand the technology, and consider the risks involved before investing in cryptocurrencies. Conclusion: understanding the different types of investments is essential for building a well-diversified investment portfolio. Each investment option comes with its own set of risks and potential returns. By carefully considering your financial goals, risk tolerance, and time horizon, you can choose the investments that align with your objectives and help you achieve financial independence. Remember to consult with a financial advisor or do thorough research before making any investment decisions. Risk and return. When it comes to investing, one of the most important concepts to understand is the relationship between risk and return. Every investment carries a certain level of risk, and the potential return is often correlated with that risk. In this section, we will explore the concept of risk and return and how it can impact your investment decisions. Understanding risk. Risk refers to the possibility of losing money or not achieving the expected return on an investment. All investments come with some level of risk, and it is important to understand and assess the risks associated with each investment before making a decision. There are several types of risks that investors should be aware of. Market risk. This is the risk that the overall market will decline, causing the value of your investments to decrease. Market risk is influenced by factors such as economic conditions, political events, and investor sentiment. Credit risk. This is the risk that a borrower will default on their debt obligations, resulting in a loss for the lender. Credit risk is particularly relevant when investing in bonds or lending money to individuals or companies. Inflation risk. Inflation erodes the purchasing power of money over time. If the rate of inflation is higher than the return on your investments, you may experience a decrease in real value. Liquidity risk. This refers to the risk of not being able to sell an investment quickly and at a fair price. Investments that are less liquid, such as real estate or certain types of bonds, may be more difficult to sell in a short period of time. Concentration risk. This is the risk of having a significant portion of your investments in a single asset or sector. If that asset or sector performs poorly, it can have a significant impact on your overall portfolio. Assessing risk tolerance. Before making any investment decisions, it is important to assess your risk tolerance. Risk tolerance refers to your ability and willingness to take on risk in pursuit of higher returns. It is influenced by factors such as your financial goals, time horizon, and personal comfort level with volatility. To assess your risk tolerance, consider the following. Financial goals. Determine your short-term and long-term financial goals. If you have a longer time horizon, you may be able to tolerate more risk in pursuit of higher returns. On the other hand, if you have a shorter time horizon or specific financial obligations, you may need to prioritize capital preservation over potential gains. Time horizon. Consider the length of time you have to invest. Generally, the longer your time horizon, the more risk you can afford to take. This is because you have more time to recover from any potential losses. Comfort with volatility. Reflect on your personal comfort level with market fluctuations. Some investors are more comfortable with the ups and downs of the market, while others prefer a more stable and predictable investment approach. Diversification. Assess the diversification of your investment portfolio. Diversification can help reduce risk by spreading your investments across different asset classes, sectors, and geographic regions. The relationship between risk and return. In general, investments with higher levels of risk tend to offer the potential for higher returns. This is known as the risk-return trade-off. Investors who are willing to take on more risk may have the opportunity to earn higher profits, but they also face a greater chance of losing money. It is important to note that the relationship between risk and return is not always linear. Some investments may offer high returns with relatively low risk, while others may have low returns despite high levels of risk. Understanding this relationship is crucial when constructing a well-balanced investment portfolio. Balancing risk and return. Finding the right balance between risk and return is a key aspect of successful investing. It is important to align your investment strategy with your risk tolerance and financial goals. Here are some strategies to consider. Asset allocation. Diversify your investments across different asset classes, such as stocks, bonds, and cash. This can help spread your risk and potentially increase your chances of achieving a favorable return. Risk management. Implement risk management strategies, such as setting stop-loss orders or using options to hedge against potential losses. These strategies can help protect your investments during periods of market volatility. Regular monitoring. Stay informed about the performance of your investments and regularly review your portfolio. This will allow you to make necessary adjustments and rebalance your portfolio as needed. Seek professional advice. Consider consulting with a financial advisor who can help you assess your risk tolerance, develop an appropriate investment strategy, and provide guidance on managing risk and maximizing returns. Remember, investing involves a certain level of risk, and there are no guarantees of returns. It is important to educate yourself, understand your risk tolerance, and make informed investment decisions based on your individual circumstances and goals. Diversification and asset allocation. Diversification and asset allocation are two key concepts in the world of investing. They are essential strategies that can help you manage risk and maximize returns in your investment portfolio. In this section, we will explore what diversification and asset allocation are, why they are important, and how you can implement them in your own investment strategy. Understanding diversification. Diversification is the practice of spreading your investments across different asset classes, industries, and geographic regions. The goal of diversification is to reduce the risk of your portfolio by not putting all your eggs in one basket. By diversifying, you can potentially minimize the impact of any single investment's poor performance on your overall portfolio. One way to achieve diversification is by investing in different types of assets, such as stocks, bonds, real estate, and commodities. Each asset class has its own risk and return characteristics, and they tend to perform differently under various market conditions. By holding a mix of assets, you can potentially offset losses in one asset class with gains in another. Another aspect of diversification is investing in different industries or sectors. Industries can be cyclical, meaning they go through periods of growth and decline at different times. By investing in a variety of industries, you can potentially benefit from the growth of some sectors while mitigating the impact of downturns in others. Furthermore, diversification can also be achieved by investing in different geographic regions. Different countries and regions may have different economic cycles and political climates. By investing globally, you can potentially benefit from the growth of emerging markets while reducing the risk associated with any single country or region. The importance of diversification. Diversification is important because it helps to reduce the overall risk of your investment portfolio. By spreading your investments across different assets, industries, and regions, you are less exposed to the risk of any single investment or market event. This can help protect your portfolio from significant losses and provide a more stable long-term return. One of the main benefits of diversification is that it can help smooth out the volatility of your portfolio. Different asset classes tend to perform differently under various market conditions. For example, when stocks are performing poorly, bonds may be performing well. By holding a mix of assets, you can potentially reduce the impact of market fluctuations on your overall portfolio. Diversification can also help you capture the potential upside of different investments. While some investments may experience periods of poor performance, others may be experiencing growth. By diversifying, you increase the likelihood of having investments that are performing well, which can help boost your overall returns. Asset allocation. Asset allocation is the process of determining how much of your investment portfolio should be allocated to different asset classes. It involves deciding the percentage of your portfolio that should be invested in stocks, bonds, real estate, and other asset classes. Asset allocation is a crucial component of a well-diversified portfolio. The key to successful asset allocation is finding the right balance between risk and return that aligns with your investment goals and risk tolerance. Generally, stocks have the potential for higher returns but also come with higher volatility and risk. Bonds, on the other hand, tend to have lower returns but provide more stability and income. The appropriate asset allocation for you will depend on factors such as your age, investment goals, time horizon, and risk tolerance. Younger investors with a longer time horizon may be able to tolerate more risk and have a higher allocation to stocks, while older investors nearing retirement may prefer a more conservative allocation with a higher percentage of bonds. It is important to regularly review and rebalance your asset allocation to ensure it remains aligned with your investment goals. Over time, the performance of different asset classes may cause your portfolio to deviate from your desired allocation. Rebalancing involves selling investments that have performed well and buying more of those that have underperformed, bringing your portfolio back to its target allocation. Implementing diversification and asset allocation. Implementing diversification and asset allocation in your investment strategy can be done in several ways. One option is to invest in mutual funds or exchange-traded funds, ETFs, that provide exposure to a diversified portfolio of assets. These funds are managed by professionals who allocate investments across different asset classes, industries, and regions. Another option is to build your own diversified portfolio by selecting individual investments. This requires research and analysis to identify investments that align with your desired asset allocation. It is important to consider factors such as the risk and return characteristics of each investment, as well as their correlation with other investments in your portfolio. Regardless of the approach you choose, it is important to regularly monitor and review your portfolio to ensure it remains diversified and aligned with your investment goals. Market conditions and your personal circumstances may change over time, requiring adjustments to your asset allocation. By staying informed and proactive, you can maximize the benefits of diversification and asset allocation in your journey towards financial independence. In the next chapter, we will delve into creating a comprehensive financial plan that incorporates the concepts of diversification and asset allocation. We will explore how to set financial goals, create a budget, and develop investment strategies that align with your unique circumstances and aspirations. Chapter 3. Creating a financial plan. Setting financial goals. Setting financial goals is an essential step towards achieving financial independence. Without clear goals, it can be challenging to stay focused and motivated on your journey to financial freedom. In this section, we will explore the importance of setting financial goals and provide you with practical steps to help you define and achieve your objectives. Why set financial goals? Setting financial goals provides you with a roadmap for your financial journey. It helps you prioritize your spending, saving, and investing decisions, ensuring that you are working towards something meaningful. Here are a few reasons why setting financial goals is crucial. Clarity and focus. Financial goals give you a clear direction and purpose. They help you identify what you want to achieve and provide a sense of focus in your financial decision-making. Motivation. Having specific financial goals can be highly motivating. It gives you something to strive for and keeps you committed to your financial plan, even during challenging times. Measure of progress. Financial goals act as a benchmark to measure your progress. They allow you to track your achievements and make adjustments if necessary. Financial discipline. Setting goals requires discipline and self-control. It helps you develop healthy financial habits and avoid impulsive spending or investing decisions. Steps to setting financial goals. Now that you understand the importance of setting financial goals, let's dive into the steps you can take to define your objectives effectively. Step 1. Reflect on your values and priorities. Before setting financial goals, it's essential to reflect on your values and priorities. Ask yourself what matters most to you in life. Is it early retirement, buying a home, starting a business, or providing for your family's future? Understanding your values will help you align your financial goals with what truly matters to you. Step 2. Define specific and measurable goals. To make your financial goals actionable, they need to be specific and measurable. Instead of setting a vague goal like save more money, be specific about how much you want to save and by when. For example, save $10,000 for a down payment on a house within the next 2 years. This clarity will help you stay focused and track your progress effectively. Step 3. Set short-term and long-term goals. It's important to set both short-term and long-term financial goals. Short-term goals can be achieved within a year or less, while long-term goals may take several years or even decades. Short-term goals provide you with quick wins and keep you motivated, while long-term goals ensure you are working towards your bigger financial aspirations. Step 4. Make your goals realistic and attainable. While it's great to dream big, it's also important to make your goals realistic and attainable. Setting unattainable goals can lead to frustration and disappointment. Consider your current financial situation, income, and expenses when setting your goals. It's okay to stretch yourself, but ensure that your goals are within reach with proper planning and effort. Step 5. Break down your goals into actionable steps. Once you have defined your financial goals, break them down into smaller, actionable steps. This will make them more manageable and less overwhelming. For example, if your goal is to pay off $20,000 in credit card debt within 2 years, break it down into monthly or quarterly targets. This approach will help you stay on track and celebrate small victories along the way. Step 6. Prioritize your goals. If you have multiple financial goals, prioritize them based on their importance and urgency. Determine which goals are critical for your financial well-being and focus on those first. By prioritizing your goals, you can allocate your resources and efforts more effectively. Step 7. Review and adjust your goals regularly. Financial goals are not set in stone. As your circumstances change, it's important to review and adjust your goals regularly. Life events, such as marriage, having children, or a career change, may require you to modify your goals. Regularly reassessing your goals will ensure they remain relevant and aligned with your evolving financial situation. Conclusion. Setting financial goals is a crucial step towards achieving financial independence. It provides you with direction, motivation, and a measure of progress on your financial journey. By following the steps outlined in this section, you can define meaningful and achievable goals that will guide your financial decisions and help you build a solid foundation for a financially secure future. Remember, the key is to stay committed, track your progress, and make adjustments as needed to stay on course towards your financial goals. Creating a budget. Creating a budget is a crucial step in managing your finances and working towards financial independence. A budget helps you track your income and expenses, prioritize your spending, and ensure that you are saving and investing for the future. In this section, we will discuss the steps to create an effective budget that aligns with your financial goals. Assess your current financial situation. Before you can create a budget, it is important to assess your current financial situation. This involves gathering information about your income, expenses, debts, and assets. Start by calculating your total monthly income, including your salary, bonuses, and any other sources of income. Next, list down all your monthly expenses, such as rent and mortgage, utilities, groceries, transportation, and entertainment. Be thorough and include both fixed and variable expenses. Once you have a clear picture of your income and expenses, calculate your net income by subtracting your total expenses from your total income. This will give you an idea of how much money you have left over each month. Additionally, assess your debts and assets. List down all your debts, including credit card balances, student loans, and any other outstanding loans. On the other hand, list down your assets, such as savings accounts, investments, and property. Set financial goals. The next step in creating a budget is to set financial goals. Financial goals provide you with a clear direction and purpose for your budget. They can be short-term goals, such as paying off credit card debt, or long-term goals, such as saving for retirement or buying a house. When setting your goals, make sure they are specific, measurable, achievable, relevant, and time-bound, SMART goals. Once you have identified your financial goals, prioritize them based on their importance and urgency. This will help you allocate your resources effectively and ensure that you are working towards your most important goals first. Remember, your budget should reflect your priorities and values. Track your income and expenses. To create an effective budget, you need to track your income and expenses regularly. This will help you identify areas where you can cut back on spending and find opportunities to save and invest. Start by recording all your income sources and the amount you receive from each source. This can include your salary, freelance income, rental income, or any other sources of income. Next, track your expenses by categorizing them into different categories such as housing, transportation, groceries, entertainment, and debt payments. Use a spreadsheet, budgeting app, or a pen and paper to record your expenses. Be diligent and record every expense, no matter how small. This will give you a clear picture of where your money is going and help you identify areas where you can make adjustments. Analyze your spending patterns. Once you have tracked your income and expenses for a few months, it's time to analyze your spending patterns. Look for trends and patterns in your spending habits. Are there any areas where you are overspending? Are there any expenses that can be reduced or eliminated? Analyzing your spending patterns will help you identify areas where you can make adjustments to align your spending with your financial goals. Consider using budgeting tools or apps that can automatically categorize your expenses and provide you with visual representations of your spending. This can make it easier to identify areas where you may be overspending and help you make informed decisions about where to cut back. Create a realistic budget. Based on your assessment of your current financial situation, your financial goals, and your spending patterns, it's time to create a realistic budget. A realistic budget is one that takes into account your income, expenses, and financial goals while allowing for some flexibility and unexpected expenses. Start by allocating a portion of your income towards your financial goals. This can include saving for emergencies, paying off debt, and investing for the future. Next, allocate funds for your fixed expenses such as rent or mortgage, utilities, and debt payments. Finally, allocate funds for your variable expenses such as groceries, transportation, and entertainment. Make sure that your expenses do not exceed your income. If you find that your expenses are higher than your income, you may need to make some adjustments. Look for areas where you can cut back on spending or find ways to increase your income. Remember, a budget is a flexible tool that can be adjusted as your financial situation changes. Stick to your budget. Creating a budget is only the first step. To achieve financial independence, it is important to stick to your budget consistently. This requires discipline and commitment. Here are a few tips to help you stick to your budget. Track your expenses regularly. Continuously track your expenses and compare them to your budget. This will help you stay on track and identify any areas where you may be overspending. Automate your savings. Set up automatic transfers to your savings and investment accounts. This will ensure that you are consistently saving and investing without having to rely on willpower alone. Review and adjust your budget. Regularly review your budget and make adjustments as needed. Life circumstances and financial goals may change, so it's important to adapt your budget accordingly. Stay motivated, keep your financial goals in mind, and remind yourself of the benefits of sticking to your budget. Celebrate small victories along the way to stay motivated. By creating a budget and sticking to it, you are taking control of your finances and working towards financial independence. Remember, a budget is a tool that empowers you to make informed financial decisions and achieve your financial goals. Investment strategies. Investment strategies play a crucial role in achieving financial independence. They are the plans and approaches that individuals use to grow their wealth over time. While there are various investment strategies available, it is important to choose the ones that align with your financial goals, risk tolerance, and time horizon. In this section, we will explore some popular investment strategies that can help you on your path to financial independence. Asset allocation. Asset allocation is a fundamental investment strategy that involves dividing your investment portfolio among different asset classes, such as stocks, bonds, and cash. The goal of asset allocation is to create a diversified portfolio that balances risk and return. By spreading your investments across different asset classes, you can potentially reduce the impact of market volatility on your overall portfolio. The key to successful asset allocation is determining the right mix of assets based on your risk tolerance and investment goals. Generally, younger individuals with a longer time horizon can afford to take on more risk and allocate a higher percentage of their portfolio to stocks, which have historically provided higher returns over the long term. As you approach retirement, it is advisable to gradually shift your asset allocation towards more conservative investments, such as bonds and cash, to preserve capital. Dollar cost averaging. Dollar cost averaging is an investment strategy that involves investing a fixed amount of money at regular intervals, regardless of the market conditions. This strategy takes advantage of market fluctuations by buying more shares when prices are low and fewer shares when prices are high. Over time, this approach can help smooth out the impact of market volatility and potentially lower the average cost per share. Dollar cost averaging is particularly beneficial for long-term investors who are focused on accumulating wealth over time. By consistently investing a fixed amount, you remove the need to time the market and avoid making emotional investment decisions based on short-term market movements. This strategy allows you to take advantage of the power of compounding and can lead to significant wealth accumulation over the long term. Buy and hold. The buy and hold strategy involves purchasing investments with the intention of holding them for an extended period, regardless of short-term market fluctuations. This strategy is based on the belief that over the long term, the market tends to rise, and quality investments will appreciate in value. By adopting a buy and hold approach, investors can avoid the temptation to make frequent trades and potentially incur unnecessary transaction costs. The key to successful buy and hold investing is selecting high-quality investments with strong fundamentals and long-term growth potential. It is important to conduct thorough research and due diligence before making any investment decisions. Once you have identified suitable investments, it is crucial to have the discipline to stay invested and resist the urge to sell during periods of market volatility. Index fund investing. Index fund investing is a passive investment strategy that aims to replicate the performance of a specific market index, such as the S&P 500. Instead of trying to beat the market, index fund investors seek to match the returns of the overall market. This strategy is based on the belief that over the long term, the market as a whole tends to outperform the majority of actively managed funds. Index funds offer several advantages, including low fees, broad market exposure, and simplicity. By investing in a diversified index fund, you can gain exposure to a wide range of companies and industries without the need for extensive research and stock picking. This strategy is particularly suitable for investors who prefer a hands-off approach and want to minimize the impact of fees on their investment returns. Dividend investing. Dividend investing involves purchasing stocks of companies that regularly distribute a portion of their profits to shareholders in the form of dividends. This strategy focuses on generating a steady stream of income from dividend payments in addition to potential capital appreciation. Dividend investing is popular among income-oriented investors who prioritize regular cash flow from their investments. When selecting dividend stocks, it is important to consider factors such as the company's dividend history, payout ratio, and financial stability. Companies with a consistent track record of increasing dividends over time are often preferred by dividend investors. Additionally, diversifying your dividend portfolio across different sectors and industries can help mitigate the risk of relying too heavily on a single company or sector. Growth investing. Growth investing involves investing in companies that have the potential for above-average growth in earnings and stock price. This strategy focuses on capital appreciation rather than generating immediate income through dividends. Growth investors typically look for companies with innovative products or services, strong competitive advantages, and a track record of consistent growth. Investing in growth stocks can be rewarding but also carries higher risk compared to other investment strategies. Growth companies often operate in dynamic industries and may experience significant price volatility. It is important to conduct thorough research and carefully evaluate the growth prospects of companies before investing. Additionally, diversification is crucial to mitigate the risk associated with investing in individual growth stocks. Value investing. Value investing is an investment strategy that involves identifying undervalued stocks and purchasing them at a price below their intrinsic value. This strategy is based on the belief that the market sometimes misprices stocks, providing opportunities for investors to buy quality companies at a discount. Value investors typically focus on companies with strong fundamentals, stable cash flows, and a margin of safety. Successful value investing requires patience and discipline. It may take time for the market to recognize the true value of undervalued stocks, and investors must be willing to hold their investments until the market corrects itself. Value investing is often associated with long-term investing and can be a suitable strategy for investors who are willing to take a contrarian approach and have a long-term investment horizon. In conclusion, investment strategies are essential tools for achieving financial independence. By diversifying your portfolio, adopting a disciplined approach, and aligning your investments with your financial goals, you can increase your chances of building long-term wealth. Remember that investment strategies should be tailored to your individual circumstances, and it is always advisable to seek professional advice before making any investment decisions. Retirement planning. Retirement planning is a crucial aspect of your financial journey. It involves making strategic decisions and taking necessary steps to ensure a comfortable and secure retirement. While retirement may seem far off in the future, it is never too early to start planning for it. In this section, we will explore the key steps to retirement planning and how you can set yourself up for financial independence in your golden years. Assessing your retirement needs. The first step in retirement planning is to assess your retirement needs. This involves determining how much money you will need to maintain your desired lifestyle during retirement. Consider factors such as your current expenses, expected inflation rates, and any additional expenses you may have, such as healthcare costs. It is important to be realistic and conservative in your estimates to ensure you have enough funds to last throughout your retirement years. To assess your retirement needs, start by evaluating your current expenses. Take a close look at your monthly budget and identify any areas where you can potentially reduce expenses. This exercise will give you a clearer picture of your current spending habits and help you identify areas where you can make adjustments to save more for retirement. Next, consider the impact of inflation on your retirement savings. Inflation erodes the purchasing power of money over time, meaning that the same amount of money will buy less in the future. To account for inflation, it is recommended to use a conservative estimate of around 3% per year when projecting your future expenses. Lastly, factor in any additional expenses you may have during retirement. This could include healthcare costs, travel expenses, or any other activities or hobbies you plan to pursue. By considering these factors, you can arrive at a more accurate estimate of your retirement needs. Setting retirement goals. Once you have assessed your retirement needs, the next step is to set clear retirement goals. Retirement goals will help you stay focused and motivated throughout your financial journey. Start by determining the age at which you would like to retire. This will give you a timeline to work with and help you plan accordingly. Next, consider the lifestyle you envision for your retirement years. Do you want to travel extensively, pursue hobbies, or simply enjoy a relaxed and comfortable lifestyle? Having a clear vision of your retirement goals will help you determine how much money you need to save and invest to achieve those goals. It is also important to consider any other financial goals you may have, such as paying off your mortgage or funding your children's education. By prioritizing your goals and aligning them with your retirement plans, you can create a comprehensive financial plan that covers all aspects of your financial life. Saving and investing for retirement. Once you have assessed your retirement needs and set clear goals, the next step is to start saving and investing for retirement. Saving for retirement is a long-term commitment that requires discipline and consistency. Here are some key strategies to help you save and invest effectively. Start early. The power of compounding works in your favor when you start saving for retirement early. Even small contributions made consistently over a long period can grow significantly over time. Contribute to retirement accounts. Take advantage of retirement accounts such as 401(k)s or IRAs, individual retirement accounts. These accounts offer tax advantages and can help your savings grow faster. Maximize employer contributions. If your employer offers a matching contribution to your retirement account, make sure to contribute enough to receive the maximum match. This is essentially free money that can significantly boost your retirement savings. Diversify your investments. Spread your investments across different asset classes to reduce risk. Consider a mix of stocks, bonds, and other investment vehicles that align with your risk tolerance and retirement goals. Review and adjust your investments. Regularly review your investment portfolio and make adjustments as needed. As you approach retirement, you may want to shift towards more conservative investments to protect your savings. Stay disciplined, stick to your savings and investment plan even during market fluctuations. Avoid making impulsive decisions based on short-term market movements and focus on your long-term goals. Monitoring and adjusting your retirement plan. Retirement planning is not a one-time activity. It requires regular monitoring and adjustments to ensure you stay on track. Here are some key steps to effectively monitor and adjust your retirement plan. Regularly review your progress, monitor your retirement savings and investment performance on a regular basis. This will help you gauge whether you are on track to meet your retirement goals or if adjustments are needed. Reassess your retirement needs. As you approach retirement, reassess your retirement needs and make any necessary adjustments. Consider factors such as changes in lifestyle, healthcare costs, and inflation rates. Seek professional advice. Consider consulting with a financial advisor who specializes in retirement planning. They can provide valuable insights and help you make informed decisions about your retirement strategy. Make necessary adjustments. If you find that you are not on track to meet your retirement goals, make adjustments to your savings and investment strategy. This may involve increasing your savings rate, adjusting your asset allocation, or exploring additional income streams. Remember, retirement planning is a dynamic process that requires flexibility and adaptability. By regularly monitoring and adjusting your retirement plan, you can ensure that you are on the right path towards financial independence in your golden years. Estate planning. Estate planning is an essential aspect of your overall financial plan. It involves making arrangements for the management and distribution of your assets after your death. While it may not be the most pleasant topic to think about, estate planning is crucial to ensure that your loved ones are taken care of and your wishes are carried out. Understanding estate planning. Estate planning involves several key components, including creating a will, establishing trusts, designating beneficiaries, and minimizing estate taxes. Let's take a closer look at each of these elements. Creating a will. A will is a legal document that outlines how you want your assets to be distributed after your death. It allows you to specify who will inherit your property, money, and other possessions. Without a will, your assets may be distributed according to state laws, which may not align with your wishes. When creating a will, it is important to consider the following. Choose an executor. An executor is responsible for carrying out the instructions in your will. Select someone you trust and who is capable of handling the responsibilities. Specify beneficiaries. Clearly identify who will receive your assets. You can allocate specific items or percentages of your estate to different individuals or organizations. Consider guardianship. If you have minor children, you can use your will to designate a guardian who will take care of them in the event of your death. Update regularly. Life circumstances change, so it's important to review and update your will periodically to ensure it reflects your current wishes. Establishing trusts. A trust is a legal arrangement that allows a third party, known as a trustee, to hold and manage assets on behalf of beneficiaries. Trusts can be useful for various reasons, such as providing for minor children, protecting assets from creditors, and minimizing estate taxes. There are different types of trusts, including revocable and irrevocable trusts. Revocable trusts can be changed or revoked during your lifetime, while irrevocable trusts cannot be altered once established. It's important to consult with an estate planning attorney to determine which type of trust is most suitable for your needs. Designating beneficiaries. In addition to creating a will and establishing trusts, it's important to designate beneficiaries for your retirement accounts, life insurance policies, and other financial accounts. By naming beneficiaries, you ensure that these assets pass directly to the designated individuals, bypassing the probate process. When designating beneficiaries, consider the following. Keep beneficiaries updated, review and update your beneficiary designations regularly, especially after major life events such as marriage, divorce, or the birth of a child. Consider contingent beneficiaries. In case your primary beneficiary predeceases you, it's wise to name contingent beneficiaries who will receive the assets. Consult with professionals, seek guidance from financial advisors and estate planning attorneys to ensure your beneficiary designations align with your overall estate plan. Minimizing estate taxes. Estate taxes, also known as inheritance taxes or death taxes, are taxes imposed on the transfer of assets after death. The tax laws regarding estate taxes vary by country and can be complex. However, there are strategies you can employ to minimize the impact of estate taxes on your estate. Some common estate tax planning techniques include gifting. By gifting assets during your lifetime, you can reduce the size of your taxable estate. There are annual gift tax exclusions and lifetime gift tax exemptions that you can take advantage of. Charitable giving. Donating to charitable organizations can provide tax benefits and reduce the size of your taxable estate. Irrevocable life insurance trusts. Placing life insurance policies in an irrevocable trust can help remove the death benefit from your taxable estate. The importance of estate planning. Estate planning is not just for the wealthy or the elderly. It is a critical aspect of financial planning for individuals of all ages and income levels. Here are some reasons why estate planning is important. Protecting your loved ones. Estate planning allows you to protect your loved ones by ensuring that your assets are distributed according to your wishes. Without a proper estate plan, your assets may be subject to probate, which can be a lengthy and costly process. By having a clear plan in place, you can minimize the burden on your loved ones during an already difficult time. Providing for minor children. If you have minor children, estate planning is crucial for designating a guardian who will take care of them in the event of your death. Without a designated guardian, the court may appoint someone who may not align with your values or wishes. By including this provision in your will, you can ensure that your children are cared for by someone you trust. Avoiding family disputes. Estate planning can help prevent family disputes and conflicts over the distribution of assets. By clearly outlining your wishes in a legally binding document, you can minimize the potential for disagreement among family members. This can help preserve family relationships and ensure that your intentions are carried out. Minimizing estate taxes. Proper estate planning can help minimize the impact of estate taxes on your estate. By employing various tax planning strategies, you can potentially reduce the amount of taxes that your beneficiaries will have to pay. This can help preserve more of your wealth for future generations. Seeking professional guidance. Estate planning can be complex, and it's important to seek professional guidance to ensure that your plan is comprehensive and legally sound. Consider consulting with the following professionals. Estate planning attorney. An attorney specializing in estate planning can help you navigate the legal complexities and ensure that your wishes are properly documented. Financial advisor. A financial advisor can provide guidance on how to structure your estate plan in a way that aligns with your overall financial goals. Tax professional. A tax professional can help you understand the tax implications of your estate plan and assist in implementing strategies to minimize taxes. Remember, estate planning is an ongoing process. It's important to review and update your plan regularly to reflect any changes in your life circumstances or financial goals. By taking the time to create a comprehensive estate plan, you can have peace of mind knowing that your loved ones will be taken care of and your assets will be distributed according to your wishes. Chapter 4. Managing income and expenses. Increasing income. Increasing your income is a crucial step towards achieving financial independence. While managing expenses and saving money are important, it is equally important to focus on increasing your income. By increasing your income, you can have more money to save, invest, and build wealth. In this section, we will explore various strategies and techniques that can help you increase your income. Enhancing your skills and education. One of the most effective ways to increase your income is by enhancing your skills and education. Continuously learning and upgrading your skills can make you more valuable in the job market and open up new opportunities for higher-paying jobs. Consider pursuing additional certifications, attending workshops or seminars, or even going back to school to earn a higher degree. By investing in your education and skills, you can position yourself for better-paying jobs or even start your own business. Negotiating a higher salary. Negotiating a higher salary is another powerful way to increase your income. Many people are hesitant to negotiate their salary, but it is an essential skill to master. Before entering into salary negotiations, research the market value for your position and gather evidence of your accomplishments and contributions to the company. Present your case confidently and be prepared to negotiate. Remember, the worst that can happen is that your employer says no, but you may be surprised at how often they are willing to meet you halfway. Seeking career advancement opportunities. Advancing in your career can lead to higher income opportunities. Take the initiative to seek out promotions or apply for higher-level positions within your organization. Demonstrate your commitment, dedication, and willingness to take on additional responsibilities. Seek feedback from your superiors and work on improving your skills and knowledge in areas that align with your career goals. By actively pursuing career advancement, you can increase your earning potential and move closer to financial independence. Exploring side hustles and freelancing. In addition to your primary job, consider exploring side hustles or freelancing opportunities to supplement your income. Side hustles can range from freelance writing, graphic design, tutoring, or even starting a small business. Identify your skills and interests and find ways to monetize them. The gig economy offers numerous opportunities to earn extra income, and with the flexibility it provides, you can choose to work on your side hustle during your free time. By diversifying your income streams, you can increase your overall earning potential. Investing in passive income sources. Passive income sources can provide a steady stream of income without requiring active participation. Investing in rental properties, dividend-paying stocks, or peer-to-peer lending platforms are examples of passive income sources. While building passive income streams may require upfront investment and effort, they can generate income over the long term and contribute to your financial independence. Research different passive income opportunities and choose ones that align with your financial goals and risk tolerance. Building a personal brand. Building a personal brand can help you stand out in your industry and attract higher-paying opportunities. Establishing yourself as an expert in your field through blogging, speaking engagements, or publishing articles can enhance your professional reputation. Utilize social media platforms to showcase your expertise and connect with industry professionals. By building a strong personal brand, you can increase your visibility and credibility, which can lead to higher income opportunities. Networking and building relationships. Networking and building relationships are essential for career growth and income enhancement. Attend industry conferences, join professional organizations, and actively engage with colleagues and mentors. Networking can lead to job opportunities, referrals, and valuable connections that can help you advance in your career. Building strong relationships with influential individuals in your industry can open doors to higher-paying positions or even entrepreneurial partnerships. Invest time and effort in nurturing your professional network to increase your income potential. Embracing entrepreneurship. Starting your own business can provide unlimited income potential and the freedom to control your financial destiny. Entrepreneurship requires dedication, hard work, and a willingness to take risks, but it can be incredibly rewarding. Identify a market need or a passion that you can turn into a profitable business. Develop a business plan, secure funding if necessary, and take the leap into entrepreneurship. While it may take time to build a successful business, the potential for financial independence is significant. Increasing your income is a critical component of achieving financial independence. By enhancing your skills, negotiating a higher salary, seeking career advancement opportunities, exploring side hustles, investing in passive income sources, building a personal brand, networking, and embracing entrepreneurship, you can significantly increase your earning potential. Remember, increasing your income is not an overnight process, but with persistence, determination, and a strategic approach, you can pave your path to financial freedom. Reducing expenses. Reducing expenses is a crucial step in achieving financial independence. By cutting back on unnecessary spending and finding ways to save money, you can free up more of your income to put towards your financial goals. In this section, we will explore various strategies and tips to help you reduce your expenses and take control of your finances. Analyzing your spending habits. The first step in reducing expenses is to analyze your spending habits. Take a close look at your monthly expenses and identify areas where you can cut back. Start by categorizing your expenses into essential and non-essential categories. Essential expenses include things like rent or mortgage payments, utilities, groceries, and transportation. Non-essential expenses are discretionary items like dining out, entertainment, and shopping. Once you have categorized your expenses, review each category and identify areas where you can make cuts. For example, you might consider reducing your dining out budget by cooking more meals at home or finding cheaper alternatives for entertainment. By being mindful of your spending habits and making small adjustments, you can significantly reduce your monthly expenses. Creating a budget. Creating a budget is an essential tool for managing your expenses effectively. A budget helps you track your income and expenses, allowing you to see where your money is going and make necessary adjustments. Start by listing all your sources of income and then subtract your fixed expenses, such as rent or mortgage payments, utilities, and loan payments. The remaining amount is what you have available for discretionary spending and savings. When creating your budget, be realistic about your expenses and set realistic goals. Allocate a certain amount for each category, such as groceries, transportation, and entertainment. Stick to your budget as much as possible and regularly review it to ensure you are staying on track. Cutting back on discretionary expenses. Discretionary expenses are often the easiest to cut back on when trying to reduce expenses. Look for areas where you can make small changes that can add up over time. For example, consider cutting back on your daily coffee shop visits and brewing your coffee at home. Instead of eating out for lunch every day, pack a homemade lunch. These small changes can save you a significant amount of money over the long run. Another way to reduce discretionary expenses is to negotiate or shop around for better deals. For example, you can negotiate lower rates for your cable or internet services or switch to a more affordable provider. Look for sales and discounts when shopping for clothes or household items. By being proactive and seeking out better deals, you can save money on everyday expenses. Minimizing fixed expenses. While fixed expenses are more challenging to reduce, there are still ways to minimize them. Start by reviewing your bills and contracts to see if there are any opportunities for savings. For example, you might be able to negotiate a lower interest rate on your mortgage or refinance your student loans to get a better rate. Consider downsizing your living space or moving to a more affordable area if your housing costs are too high. Another way to minimize fixed expenses is to be mindful of your energy usage. Turn off lights and appliances when not in use, adjust your thermostat to save on heating and cooling costs, and consider installing energy-efficient appliances. These small changes can help reduce your monthly utility bills. Avoiding impulse purchases. Impulse purchases can quickly derail your efforts to reduce expenses. Before making a purchase, take a moment to evaluate whether it is a necessity or a want. Ask yourself if the item is something you truly need or if it is just a fleeting desire. Consider implementing a waiting period before making non-essential purchases. Give yourself a day or two to think it over and determine if it is something you genuinely need or if it was just an impulse. Another helpful strategy is to create a list before going shopping and stick to it. Avoid browsing through stores aimlessly, as this can lead to unnecessary purchases. By being mindful of your spending and avoiding impulse purchases, you can significantly reduce your expenses. Seeking out cost-saving opportunities. Reducing expenses doesn't mean sacrificing quality or enjoyment. Look for cost-saving opportunities that allow you to maintain your lifestyle while saving money. For example, consider joining a loyalty program or using coupons when shopping for groceries or other necessities. Take advantage of free or low-cost entertainment options, such as visiting local parks or attending community events. Additionally, consider exploring alternative transportation options to save on fuel and maintenance costs. Carpooling, using public transportation, or biking to work can help reduce your monthly transportation expenses. Look for ways to save on insurance premiums by comparing rates from different providers or bundling your policies. Tracking your progress. As you implement these strategies to reduce expenses, it is essential to track your progress. Regularly review your budget and compare your actual spending to your planned expenses. This will help you identify areas where you may need to make further adjustments. Use budgeting apps or spreadsheets to track your expenses easily and stay organized. By tracking your progress, you can see the impact of your efforts and stay motivated to continue reducing expenses. Celebrate your achievements along the way and reward yourself for reaching milestones. Remember that reducing expenses is a long-term commitment, and small changes can add up to significant savings over time. In conclusion, reducing expenses is a vital step in achieving financial independence. By analyzing your spending habits, creating a budget, cutting back on discretionary expenses, minimizing fixed expenses, avoiding impulse purchases, seeking out cost-saving opportunities, and tracking your progress, you can take control of your finances and work towards your financial goals. Remember that every dollar saved is a step closer to financial freedom. Managing taxes. Managing taxes is an essential aspect of personal finance that can significantly impact your financial well-being. Taxes are a necessary part of our society as they fund public services and infrastructure. However, understanding how to manage your taxes effectively can help you minimize your tax liability and maximize your financial resources. In this section, we will explore various strategies and considerations for managing taxes and optimizing your financial situation. Understanding the tax system. Before diving into tax management strategies, it is crucial to have a basic understanding of the tax system. Taxes can be complex, with different rules and regulations depending on your country and jurisdiction. It is essential to familiarize yourself with the tax laws that apply to you and stay updated on any changes or updates. The tax system typically consists of different types of taxes, such as income tax, property tax, sales tax, and capital gains tax. Each tax type has its own set of rules and rates, and it is important to understand how they apply to your specific situation. Additionally, tax laws may vary based on your income level, marital status, and other factors. Seek professional advice. Managing taxes can be a complex task, especially if you have a significant income or own a business. In such cases, it is advisable to seek professional advice from a tax accountant or tax attorney. These professionals have in-depth knowledge of tax laws and can help you navigate the complexities of the tax system. A tax professional can assist you in identifying potential deductions, credits, and exemptions that you may be eligible for. They can also help you develop tax planning strategies to minimize your tax liability legally. By working with a tax professional, you can ensure that you are taking full advantage of the tax benefits available to you while remaining compliant with the law. Tax planning and optimization. Tax planning involves strategically organizing your finances and transactions to minimize your tax liability. It is an ongoing process that requires careful consideration and proactive decision-making. Here are some key tax planning strategies to consider. Take advantage of tax-advantaged accounts. Tax-advantaged accounts, such as individual retirement accounts, IRAs, and 401k plans, offer significant tax benefits. Contributions to these accounts are often tax-deductible, and the investment growth is tax-deferred until withdrawal. By maximizing your contributions to these accounts, you can reduce your taxable income and potentially lower your tax liability. Consider tax-efficient investments. Certain investments are more tax-efficient than others. For example, investments held in a tax-advantaged account, such as an IRA, can grow tax-free. Additionally, investments that generate long-term capital gains are typically taxed at a lower rate than short-term capital gains. By strategically selecting tax-efficient investments, you can minimize the taxes you owe on investment income. Timing income and expenses. Timing your income and expenses can have a significant impact on your tax liability. For example, if you expect to be in a lower tax bracket next year, you may consider deferring income to the following year. Similarly, you can accelerate deductible expenses into the current year to reduce your taxable income. However, it is important to consult with a tax professional to ensure that these strategies align with your overall financial goals. Charitable contributions. Charitable contributions can provide both financial and tax benefits. Donating to qualified charitable organizations can result in a tax deduction, reducing your taxable income. However, it is important to keep proper documentation of your donations and ensure that you are contributing to eligible organizations. Stay organized and keep records. To effectively manage your taxes, it is crucial to stay organized and keep accurate records of your financial transactions. This includes maintaining records of income, expenses, investments, and any relevant tax documents. By keeping organized records, you can easily access the information needed to prepare your tax returns and substantiate any deductions or credits claimed. Regularly review and adjust. Tax laws and regulations are subject to change, and your financial situation may evolve over time. It is important to regularly review your tax strategy and make adjustments as necessary. This includes staying informed about any changes in tax laws, reassessing your financial goals, and consulting with a tax professional to ensure that your tax planning remains effective and aligned with your overall financial plan. By effectively managing your taxes, you can optimize your financial situation and work towards achieving financial independence. Remember, tax management is just one aspect of personal finance, and it is important to consider it within the broader context of your financial goals and strategies. Tracking and analyzing expenses. Tracking and analyzing your expenses is a crucial step in achieving financial independence. By understanding where your money is going, you can make informed decisions about your spending habits and identify areas where you can cut back or make adjustments. In this section, we will explore the importance of tracking and analyzing expenses and provide you with practical steps to help you get started. Why track and analyze expenses? Tracking and analyzing expenses is the foundation of effective financial management. It allows you to gain a clear picture of your spending patterns and helps you identify areas where you may be overspending or wasting money. By understanding your expenses, you can make informed decisions about your financial priorities and allocate your resources more effectively. Tracking your expenses also helps you identify any unnecessary or impulsive purchases that may be hindering your progress towards financial independence. It allows you to take control of your spending and make intentional choices about where your money goes. Analyzing your expenses goes beyond simply tracking them. It involves examining your spending habits, identifying trends, and evaluating whether your spending aligns with your financial goals. This analysis can help you identify areas where you can cut back, save more, or invest wisely. How to track and analyze expenses. Tracking and analyzing expenses may seem daunting at first, but with the right tools and mindset, it can become a manageable and rewarding process. Here are some steps to help you get started. Step 1. Gather your financial documents. Start by gathering all your financial documents, including bank statements, credit card statements, receipts, and any other records of your expenses. Having all your financial information in one place will make it easier to track and analyze your expenses accurately. Step 2. Categorize your expenses. Create categories for your expenses based on your spending patterns. Common categories include housing, transportation, food, utilities, entertainment, and debt payments. You can use a spreadsheet or budgeting software to organize your expenses into these categories. Step 3. Record your expenses. Record all your expenses, both big and small, in your chosen tracking system. Be diligent about entering every expense, even if it seems insignificant. This will give you a comprehensive view of your spending habits and help you identify areas where you can make adjustments. Step 4. Review and analyze your expenses. Regularly review and analyze your expenses to identify any patterns or trends. Look for areas where you may be overspending or areas where you can make cuts. For example, if you notice that you are spending a significant amount on dining out, you may consider cooking more meals at home to save money. Step 5. Set goals and make adjustments. Based on your analysis, set specific financial goals and make adjustments to your spending habits. For example, if your goal is to save more for retirement, you may decide to reduce your discretionary spending and allocate more money towards your retirement accounts. Step 6. Use technology and apps. Take advantage of technology and budgeting apps to simplify the tracking and analysis process. Many apps allow you to link your bank accounts and credit cards, automatically categorize your expenses, and generate reports. These tools can save you time and provide valuable insights into your spending habits. Step 7. Regularly review and update your budget. As your financial situation and goals change, it's important to regularly review and update your budget. Make it a habit to revisit your expenses and adjust your budget accordingly. This will ensure that you stay on track towards financial independence. Benefits of tracking and analyzing expenses. Tracking and analyzing expenses offer several benefits on your path to financial independence. 1. Increased awareness. By tracking your expenses, you become more aware of your spending habits and can make conscious decisions about where your money goes. This awareness helps you prioritize your financial goals and make adjustments to align your spending with your values. 2. Improved financial planning. Analyzing your expenses allows you to create a more accurate and realistic financial plan. You can identify areas where you can save money, allocate resources more effectively, and make informed decisions about your financial future. 3. Debt reduction. Tracking and analyzing expenses can help you identify areas where you may be overspending and wasting money. By making adjustments and cutting back on unnecessary expenses, you can free up more money to pay off debt and accelerate your journey towards financial independence. 4. Increased savings and investments. Understanding your expenses enables you to save more and invest wisely. By identifying areas where you can cut back, you can allocate more money towards savings and investments, helping you build wealth and achieve financial independence faster. 5. Financial peace of mind. When you have a clear understanding of your expenses and a solid financial plan in place, you can experience a sense of peace and security. Knowing that you are in control of your finances and making informed decisions brings a sense of confidence and reduces financial stress. Conclusion. Tracking and analyzing expenses is a fundamental step in achieving financial independence. By gaining a clear understanding of your spending habits, you can make informed decisions about your finances, prioritize your financial goals, and make adjustments to align your spending with your values. Remember, consistency is key. Regularly track and analyze your expenses, update your budget, and stay committed to your financial plan. With time and effort, you will be well on your way to financial independence. Chapter 5. Understanding credit and loans. Credit scores and reports. Your credit score is a 3-digit number that represents your creditworthiness. It is a crucial factor that lenders, landlords, and even potential employers use to evaluate your financial responsibility. A good credit score can open doors to better interest rates on loans, higher credit limits, and more favorable terms. In this section, we will explore the importance of credit scores and reports and provide you with practical steps to improve and maintain a healthy credit profile. Understanding credit scores. Credit scores are generated by credit bureaus based on the information in your credit report. The most commonly used credit scoring model is the FICO score, which ranges from 300 to 850. The higher your score, the better your creditworthiness. Several factors contribute to your credit score. Payment history. This is the most significant factor, accounting for about 35% of your score. It reflects whether you have paid your bills on time, including credit cards, loans, and mortgages. Credit utilization. This factor accounts for around 30% of your score. It measures the percentage of your available credit that you are currently using. Keeping your credit utilization below 30% is generally recommended. Length of credit history. The length of time you have had credit accounts for about 15% of your score. A longer credit history demonstrates your ability to manage credit responsibly. Credit mix. This factor accounts for approximately 10% of your score. It considers the different types of credit you have, such as credit cards, loans, and mortgages. New credit. Opening multiple new credit accounts within a short period can negatively impact your score. This factor contributes around 10% to your credit score. Obtaining your credit report. To understand your creditworthiness, it is essential to review your credit report regularly. You are entitled to one free credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, every year. You can request your reports online or by mail. When reviewing your credit report, pay attention to the following. Personal information. Ensure that your name, address, and other personal details are accurate. Accounts. Review all the accounts listed on your report, including credit cards, loans, and mortgages. Check for any errors or fraudulent activity. Payment history. Verify that your payment history is accurately reported. Look for any late payments or accounts in collections that may negatively impact your score. Credit inquiries. Check for any unauthorized credit inquiries. Too many inquiries within a short period can lower your score. Public records. Look for any bankruptcies, tax liens, or judgments that may appear on your report. Improving your credit score. If your credit score is not where you want it to be, don't worry. There are steps you can take to improve it over time. Pay your bills on time. Consistently making on-time payments is the most effective way to improve your credit score. Set up automatic payments or reminders to ensure you never miss a payment. Reduce credit card balances. Lowering your credit card balances can significantly improve your credit utilization ratio. Aim to keep your balances below 30% of your credit limit. Avoid opening unnecessary credit accounts. While it's essential to have a mix of credit, avoid opening new accounts unless necessary. Each new account creates a hard inquiry on your credit report, which can temporarily lower your score. Regularly review your credit report. Check your credit report for errors or fraudulent activity. Dispute any inaccuracies with the credit bureaus to have them corrected. Keep old accounts open. Closing old credit accounts can shorten your credit history and reduce your available credit. Unless there are compelling reasons to close an account, consider keeping it open to maintain a longer credit history. Limit credit applications. Applying for multiple credit accounts within a short period can raise red flags to lenders. Only apply for credit when necessary and be mindful of the impact on your credit score. Monitoring your credit. Maintaining a healthy credit profile requires ongoing monitoring. Here are some strategies to stay on top of your credit. Use credit monitoring services. Consider subscribing to credit monitoring services that provide regular updates on changes to your credit report, alerts for potential fraud, and credit score tracking. Set up fraud alerts. Place fraud alerts on your credit reports to be notified if someone tries to open credit in your name. This adds an extra layer of protection against identity theft. Monitor your credit card statements. Regularly review your credit card statements for any unauthorized charges. Report any suspicious activity to your credit card issuer immediately. Review your credit score annually. Take advantage of your free annual credit reports to review your credit score and report. Look for any changes or discrepancies that may require attention. By understanding credit scores and reports and taking proactive steps to improve and monitor your credit, you can build a solid foundation for your financial future. Remember, good credit habits take time to develop, but the rewards are well worth the effort. Types of loans. Loans are a common financial tool that many individuals use to achieve their goals and meet their financial needs. Understanding the different types of loans available can help you make informed decisions about borrowing money and managing your debt. In this section, we will explore some of the most common types of loans and their features. Personal loans. Personal loans are a type of unsecured loan that can be used for various purposes. Unlike secured loans, such as mortgages or auto loans, personal loans do not require collateral. This means that if you default on the loan, the lender cannot seize any specific asset. Personal loans are typically based on your creditworthiness and income. Personal loans can be used for a wide range of purposes, including debt consolidation, home improvements, medical expenses, or even funding a vacation. The interest rates on personal loans can vary depending on your credit score and the lender's terms. It's important to compare different lenders and their interest rates before committing to a personal loan. Student loans. Student loans are specifically designed to help students finance their education. These loans can be obtained from the government or private lenders. Government student loans often have lower interest rates and more flexible repayment options compared to private student loans. There are two main types of student loans: federal loans and private loans. Federal loans are funded by the government and offer benefits such as income-driven repayment plans, loan forgiveness programs, and deferment options. Private student loans, on the other hand, are offered by banks, credit unions, and other financial institutions. They usually have higher interest rates and fewer repayment options. When considering student loans, it's important to carefully evaluate your options and understand the terms and conditions of each loan. Make sure to consider the interest rates, repayment plans, and any potential benefits or drawbacks before making a decision. Mortgage loans. Mortgage loans are used to finance the purchase of a home. These loans are secured by the property itself, which means that if you fail to repay the loan, the lender can foreclose on the property. Mortgage loans typically have lower interest rates compared to other types of loans because they are considered less risky for lenders. There are different types of mortgage loans available, including fixed-rate mortgages and adjustable-rate mortgages, ARMs. With a fixed-rate mortgage, the interest rate remains the same throughout the life of the loan, providing stability and predictability in your monthly payments. ARMs, on the other hand, have an initial fixed-rate period, after which the interest rate can fluctuate based on market conditions. When applying for a mortgage loan, lenders will consider factors such as your credit score, income, and the amount of the down payment. It's important to shop around and compare different lenders to find the best mortgage loan terms for your specific needs. Auto loans. Auto loans are used to finance the purchase of a vehicle. These loans can be obtained from banks, credit unions, or car dealerships. Auto loans are secured by the vehicle itself, which means that if you default on the loan, the lender can repossess the vehicle. Auto loans can have fixed or variable interest rates, depending on the lender and the terms of the loan. The interest rates on auto loans can vary based on factors such as your credit score, the loan term, and the age of the vehicle. Before taking out an auto loan, it's important to consider your budget and determine how much you can afford to borrow. You should also research different lenders and compare their interest rates and terms to ensure you get the best deal. Business loans. Business loans are specifically designed to help entrepreneurs and business owners finance their ventures. These loans can be used for various purposes, such as starting a new business, expanding an existing business, or purchasing equipment and inventory. Business loans can be obtained from banks, credit unions, or online lenders. The terms and conditions of business loans can vary significantly depending on the lender and the specific needs of the business. Some lenders may require collateral or a personal guarantee, while others may offer unsecured loans based on the business's creditworthiness. When applying for a business loan, it's important to have a solid business plan and financial projections to demonstrate the viability of your venture. Lenders will also consider factors such as your personal credit history, the business's credit history, and the industry in which you operate. Payday loans. Payday loans are short-term loans that are typically used to cover unexpected expenses or bridge the gap between paychecks. These loans are usually for small amounts and have high interest rates and fees. Payday loans are typically repaid in full on the borrower's next payday. While payday loans can provide quick access to cash, they can also be very expensive and trap borrowers in a cycle of debt. It's important to carefully consider the terms and costs associated with payday loans before taking one out. Exploring alternative options, such as borrowing from friends or family, negotiating with creditors, or seeking assistance from non-profit organizations, may be a better choice for managing financial emergencies. Conclusion. Understanding the different types of loans available can help you make informed decisions about borrowing money and managing your debt. Whether you're considering a personal loan, a mortgage, or a business loan, it's important to carefully evaluate your options, compare different lenders, and consider the terms and conditions of each loan. By being knowledgeable about loans, you can make financial decisions that align with your goals and help you achieve financial independence. Managing credit card debt. Credit card debt can be a significant obstacle on your path to financial freedom. If not managed properly, it can quickly accumulate and become overwhelming. However, with the right strategies and discipline, you can effectively manage your credit card debt and take control of your financial situation. In this section, we will discuss some steps you can take to manage your credit card debt and work towards financial independence. Assess your current debt situation. The first step in managing your credit card debt is to assess your current situation. Take the time to gather all your credit card statements and determine the total amount of debt you owe. Make a list of each credit card, the outstanding balance, the interest rate, and the minimum monthly payment. This will give you a clear picture of your debt and help you prioritize your repayment strategy. Create a budget. Creating a budget is essential for managing credit card debt. It allows you to track your income and expenses, identify areas where you can cut back, and allocate funds towards debt repayment. Start by listing all your sources of income and then categorize your expenses into essential and non-essential items. Look for areas where you can reduce spending and allocate those savings towards paying off your credit card debt. Prioritize your debt repayment. Once you have a clear understanding of your debt and have created a budget, it's time to prioritize your debt repayment. There are two common strategies you can use: the snowball method and the avalanche method. The snowball method involves paying off your smallest debt first while making minimum payments on the rest. Once the smallest debt is paid off, you move on to the next smallest debt, and so on. This method provides a psychological boost as you see your debts being eliminated one by one. The avalanche method, on the other hand, focuses on paying off the debt with the highest interest rate first. By tackling the debt with the highest interest rate, you can save more money on interest payments in the long run. Make minimum payments on the other debts while putting extra money towards the debt with the highest interest rate. Choose the method that works best for you and stick to it. Consistency and discipline are key to successfully managing your credit card debt. Negotiate lower interest rates. High interest rates can make it difficult to pay off your credit card debt. However, you may have the option to negotiate lower interest rates with your credit card issuers. Contact your credit card companies and explain your situation. In some cases, they may be willing to lower your interest rate, especially if you have a good payment history. Lower interest rates can significantly reduce the amount of money you pay in interest and help you pay off your debt faster. Consider debt consolidation. If you have multiple credit cards with high interest rates, consolidating your debt may be a viable option. Debt consolidation involves combining all your credit card debts into a single loan with a lower interest rate. This can make it easier to manage your debt as you only have one monthly payment to make. However, it's important to carefully consider the terms and fees associated with debt consolidation before making a decision. Avoid adding to your debt. While you are working towards paying off your credit card debt, it's crucial to avoid adding to your debt. Cut up your credit cards or put them away in a safe place to resist the temptation of using them. Instead, focus on using cash or a debit card for your purchases. If you must use a credit card, make sure to pay off the balance in full each month to avoid accruing additional debt. Seek professional help if needed. If you find yourself overwhelmed with credit card debt and struggling to make progress, don't hesitate to seek professional help. Credit counseling agencies can provide guidance and assistance in managing your debt. They can help you create a debt management plan, negotiate with creditors, and provide financial education. However, it's important to research and choose a reputable agency that has your best interests in mind. Stay motivated and celebrate milestones. Managing credit card debt can be a long and challenging journey. It's important to stay motivated and celebrate milestones along the way. Set small achievable goals and reward yourself when you reach them. This will help you stay focused and motivated to continue making progress towards financial independence. Remember, managing credit card debt requires discipline, patience, and a commitment to change your financial habits. By following these steps and staying dedicated to your financial goals, you can successfully manage your credit card debt and pave the way to financial independence. Mortgages and home loans. One of the biggest financial decisions many people make in their lifetime is buying a home. For most individuals, purchasing a home requires taking out a mortgage or home loan. A mortgage is a loan provided by a financial institution, such as a bank or credit union, to help individuals finance the purchase of a property. Understanding how mortgages and home loans work is crucial for anyone looking to become a homeowner. Types of mortgages. There are several types of mortgages available, each with its own set of terms and conditions. It's important to understand the different options to choose the one that best suits your financial situation. Here are some common types of mortgages. Fixed-rate mortgage. This is the most popular type of mortgage. With a fixed-rate mortgage, the interest rate remains the same throughout the loan term, typically 15 or 30 years. This provides stability and predictability as your monthly payments remain constant. Adjustable rate mortgage, ARM, and ARM has an interest rate that can change over time. Typically, the initial interest rate is lower than that of a fixed-rate mortgage, but it can increase or decrease depending on market conditions. ARMs usually have a fixed rate for an initial period, after which the rate adjusts periodically. FHA loans. These loans are insured by the Federal Housing Administration, FHA, and are designed to help individuals with lower credit scores or limited down payment funds. FHA loans often have more flexible qualification requirements and lower down payment options. VA loans, available to eligible veterans, active duty service members, and surviving spouses. VA loans are guaranteed by the Department of Veterans Affairs. These loans often offer favorable terms, including no down payment requirement and competitive interest rates. USDA loans. The United States Department of Agriculture, USDA, offers loans to individuals in rural areas who meet certain income requirements. USDA loans often have low or no down payment options and competitive interest rates. The mortgage process. Obtaining a mortgage involves several steps, and it's important to be prepared and informed throughout the process. Here is a general overview of the mortgage process. Preparation. Before applying for a mortgage, it's essential to assess your financial situation. Determine how much you can afford to borrow by considering your income, expenses, and existing debts. It's also advisable to check your credit score and address any issues that may affect your eligibility for a mortgage. Mortgage pre-approval. Getting pre-approved for a mortgage is an important step as it shows sellers that you are a serious buyer. To get pre-approved, you will need to provide financial documents such as pay stubs, tax returns, and bank statements to the lender. They will evaluate your financial situation and determine the maximum loan amount you qualify for. House hunting. Once you are pre-approved, you can start searching for your dream home within your budget. Consider factors such as location, size, amenities, and resale value. It's important to work with a real estate agent who can guide you through the process and negotiate on your behalf. Loan application. After finding a suitable property, you will need to complete a formal loan application with the lender. This involves providing detailed information about your income, employment history, assets, and liabilities. The lender will also require an appraisal of the property to determine its value. Loan processing and underwriting. Once your application is submitted, the lender will begin processing your loan. They will verify the information provided, review your credit history, and assess the property's value. This process may involve requesting additional documentation or conducting a home inspection. Loan approval and closing. If your loan application is approved, the lender will issue a loan commitment letter outlining the terms and conditions of the mortgage. Before closing, you will need to review and sign various legal documents, including the loan agreement, mortgage note, and deed of trust. You will also need to pay closing costs, which include fees for appraisal, title search, and attorney services. Repayment. Once the loan is closed, you will begin making monthly mortgage payments according to the agreed-upon terms. It's important to budget for these payments and ensure they are made on time to maintain a good credit history. Considerations and tips. When taking out a mortgage, there are several factors to consider to ensure you make the best decision for your financial future. Here are some considerations and tips. Affordability. Calculate how much you can comfortably afford to borrow and repay each month. Consider not only the mortgage payment but also other home ownership costs such as property taxes, insurance, and maintenance. Interest rates. Compare interest rates from different lenders to find the most competitive option. Even a small difference in interest rates can significantly impact the total cost of your mortgage over time. Down payment. Save for a down payment to reduce the loan amount and potentially avoid private mortgage insurance, PMI. A larger down payment can also help you secure a lower interest rate. Closing costs. Be prepared for closing costs, which can range from 2% to 5% of the loan amount. Include these costs in your budget to avoid any last-minute financial surprises. Loan term. Consider the length of the loan term and choose one that aligns with your financial goals. A shorter term may result in higher monthly payments but can save you money on interest in the long run. Credit score. Maintain a good credit score by paying bills on time, keeping credit card balances low, and avoiding new debt. A higher credit score can help you qualify for better interest rates and loan terms. Financial stability. Ensure you have a stable income and job security before committing to a mortgage. Owning a home comes with additional financial responsibilities, so it's important to be financially prepared. Remember, buying a home is a significant financial commitment, and it's crucial to thoroughly research and understand the mortgage process. By being well-informed and making wise decisions, you can navigate the world of mortgages and home loans with confidence on your path to financial freedom. Chapter 6. Building Wealth Through Investments. Stock Market Basics. Investing in the stock market can be a powerful tool for building wealth and achieving financial independence. While it may seem intimidating at first, understanding the basics of the stock market can help you make informed investment decisions and grow your wealth over time. In this section, we will explore the fundamental concepts of the stock market and provide you with the knowledge you need to get started. What is the stock market? The stock market is a platform where individuals and institutions can buy and sell shares of publicly traded companies. When a company decides to go public, it offers a portion of its ownership in the form of shares to the public. These shares are then traded on stock exchanges, such as the New York Stock Exchange, NYSE, or the Nasdaq. How does the stock market work? The stock market operates on the principle of supply and demand. When there is high demand for a particular stock, its price tends to rise. Conversely, when there is low demand, the price may decline. The price of a stock is determined by various factors, including the company's financial performance, industry trends, and market sentiment. Investors can buy and sell stocks through brokerage accounts. A brokerage account acts as a bridge between the investor and the stock market, allowing them to place orders to buy or sell shares. When you buy a stock, you become a partial owner of the company, and your investment can increase or decrease in value based on the performance of the company and the overall market. Types of stocks. There are two main types of stocks: common stocks and preferred stocks. Common stocks represent ownership in a company and give shareholders the right to vote on certain matters and receive dividends. Preferred stocks, on the other hand, have a higher claim on the company's assets and earnings but usually do not carry voting rights. Stocks can also be classified based on the size of the company. Large-cap stocks refer to shares of well-established companies with a market capitalization of over $10 billion. Mid-cap stocks belong to companies with a market capitalization between $2 billion and $10 billion, while small-cap stocks represent companies with a market capitalization below $2 billion. Each category has its own risk and return characteristics. Investing in stocks. When investing in stocks, it is important to have a long-term perspective. The stock market can be volatile in the short term, but historically, it has provided attractive returns over the long term. By investing in a diversified portfolio of stocks, you can reduce the risk associated with individual companies and sectors. One popular strategy for investing in stocks is called buy and hold. This approach involves purchasing shares of high-quality companies and holding onto them for an extended period, regardless of short-term market fluctuations. By focusing on the underlying fundamentals of the company, such as its earnings growth, competitive advantage, and management team, investors can make informed decisions and potentially benefit from the company's long-term success. Another strategy is called value investing, which involves identifying undervalued stocks that are trading below their intrinsic value. Value investors look for companies with solid fundamentals but are temporarily out of favor with the market. By buying these stocks at a discounted price, investors aim to profit when the market recognizes their true value. Risks and rewards. Investing in the stock market comes with both risks and rewards. The potential rewards include capital appreciation, dividends, and the opportunity to participate in the growth of successful companies. However, it is important to understand that stock prices can be volatile, and there is always a risk of losing money. To mitigate the risks associated with stock market investing, it is crucial to diversify your portfolio. Diversification involves spreading your investments across different asset classes, sectors, and geographic regions. By diversifying, you can reduce the impact of any single investment on your overall portfolio and potentially minimize losses during market downturns. Additionally, staying informed and conducting thorough research before making investment decisions is essential. Understanding the financial health of the companies you invest in, analyzing market trends, and keeping up with economic news can help you make more informed investment choices. Conclusion. The stock market can be a powerful tool for building wealth and achieving financial independence. By understanding the basics of the stock market, such as how it works, the types of stocks available, and different investment strategies, you can make informed decisions and potentially benefit from the long-term growth of successful companies. Remember to diversify your portfolio, stay informed, and take a long-term perspective when investing in stocks. With time, patience, and a commitment to learning, you can navigate the stock market and work towards achieving your financial goals. Mutual funds and ETFs. Mutual funds and exchange-traded funds, ETFs, are popular investment vehicles that offer individuals the opportunity to diversify their portfolios and potentially earn returns on their investments. These investment options are particularly attractive for those who may not have the time or expertise to research and select individual stocks or bonds. In this section, we will explore the basics of mutual funds and ETFs, their advantages and disadvantages, and how they can help you build wealth and achieve financial independence. Understanding mutual funds. A mutual fund is a pool of money collected from multiple investors, which is then managed by professional fund managers. These managers invest the pooled money in a diversified portfolio of stocks, bonds, or other securities based on the fund's investment objective. When you invest in a mutual fund, you are essentially buying shares of the fund, and your returns are based on the performance of the underlying investments. One of the key advantages of mutual funds is their diversification. By investing in a mutual fund, you gain exposure to a wide range of securities, which helps spread the risk. This diversification can help reduce the impact of any single investment's poor performance on your overall portfolio. Additionally, mutual funds offer professional management, as experienced fund managers make investment decisions on behalf of the investors. There are different types of mutual funds available, each with its own investment objective and strategy. Some funds focus on specific sectors or industries, while others may invest in a mix of stocks and bonds. It's important to carefully consider your investment goals and risk tolerance before selecting a mutual fund that aligns with your needs. Advantages of mutual funds. Diversification. As mentioned earlier, mutual funds offer instant diversification by investing in a variety of securities. This diversification helps reduce the risk associated with investing in individual stocks or bonds. Professional management. Mutual funds are managed by experienced professionals who have the knowledge and expertise to make investment decisions. This can be particularly beneficial for individuals who do not have the time or expertise to actively manage their investments. Liquidity. Mutual funds are generally highly liquid, meaning you can buy or sell your shares at any time. This provides flexibility and allows you to access your money when needed. Affordability. Mutual funds typically have a low minimum investment requirement, making them accessible to a wide range of investors. This allows individuals with limited funds to start investing and benefit from professional management. Variety of options. There are numerous mutual funds available, each with its own investment objective and strategy. This allows investors to choose funds that align with their specific goals, whether it's growth, income, or a combination of both. Disadvantages of mutual funds. Fees and expenses. Mutual funds charge fees and expenses, which can eat into your overall returns. These fees may include management fees, administrative expenses, and sales charges. It's important to carefully review the fees associated with a mutual fund before investing. Lack of control. When you invest in a mutual fund, you are entrusting the fund manager with the decision-making process. This means you have limited control over the individual investments within the fund. Capital gains taxes. Mutual funds distribute capital gains to their shareholders, which may result in tax liabilities for investors, even if they did not sell their shares. It's important to consider the tax implications of investing in mutual funds. Understanding ETFs. Exchange-traded funds, ETFs, are similar to mutual funds in that they pool money from multiple investors to invest in a diversified portfolio of securities. However, there are some key differences between the two. Unlike mutual funds, ETFs are traded on stock exchanges, which means their prices fluctuate throughout the trading day. This provides investors with the flexibility to buy or sell ETF shares at any time during market hours. Additionally, ETFs are typically passively managed and aim to replicate the performance of a specific index, such as the S&P 500. ETFs offer several advantages, including diversification. Like mutual funds, ETFs provide instant diversification by investing in a basket of securities. This helps spread the risk and reduces the impact of any single investment's poor performance. Liquidity. ETFs can be bought or sold on stock exchanges throughout the trading day, providing investors with liquidity and flexibility. Lower expenses. ETFs generally have lower expense ratios compared to mutual funds. This is because ETFs are passively managed and aim to replicate the performance of an index, rather than actively selecting individual securities. Tax efficiency. ETFs are structured in a way that allows for greater tax efficiency compared to mutual funds. This is because ETFs have the ability to minimize capital gains distributions, resulting in potential tax savings for investors. However, it's important to note that ETFs also have some disadvantages, including brokerage commissions. When buying or selling ETF shares, investors may incur brokerage commissions. These commissions can add up, particularly for frequent traders. Price fluctuations. ETF prices can fluctuate throughout the trading day, which may result in potential price discrepancies between the ETF's net asset value, NAV, and its market price. Limited investment options. While there are numerous ETFs available, the range of investment options may be more limited compared to mutual funds. This means you may not find an ETF that perfectly aligns with your specific investment goals. In conclusion, mutual funds and ETFs are popular investment options that offer individuals the opportunity to diversify their portfolios and potentially earn returns on their investments. Both options have their advantages and disadvantages, and it's important to carefully consider your investment goals, risk tolerance, and fees associated with each option before making a decision. By understanding the basics of mutual funds and ETFs, you can make informed investment choices that align with your financial goals and help you on your path to financial independence. Real estate investments. Real estate investments can be a powerful tool for building wealth and achieving financial independence. Investing in real estate offers several advantages, including potential appreciation in property value, passive income through rental properties, and tax benefits. However, like any investment, real estate comes with its own set of risks and challenges. In this section, we will explore the different types of real estate investments, the benefits and drawbacks of each, and the steps you can take to successfully invest in real estate. Residential real estate. Residential real estate refers to properties that are used for residential purposes, such as single-family homes, apartments, and condominiums. Investing in residential real estate can be a great way to generate passive income through rental properties. By purchasing a property and renting it out to tenants, you can earn a steady stream of rental income that can help you build wealth over time. One of the main advantages of residential real estate is its stability. People will always need a place to live, so there will always be demand for rental properties. Additionally, residential real estate tends to appreciate in value over time, allowing you to build equity in your investment. However, investing in residential real estate also comes with its challenges. Managing rental properties can be time-consuming and requires a certain level of expertise. You will need to find reliable tenants, handle maintenance and repairs, and deal with any legal or financial issues that may arise. It's important to carefully consider the responsibilities and potential risks before investing in residential real estate. Commercial real estate. Commercial real estate refers to properties that are used for business purposes, such as office buildings, retail spaces, and industrial properties. Investing in commercial real estate can offer higher potential returns compared to residential real estate, but it also comes with higher risks and requires a larger initial investment. One of the main advantages of commercial real estate is the potential for higher rental income. Commercial properties tend to have longer lease terms and higher rental rates, which can result in greater cash flow. Additionally, commercial real estate can offer diversification benefits, as it is less influenced by individual tenants compared to residential properties. However, investing in commercial real estate requires a deeper understanding of the market and the ability to analyze potential risks. Commercial properties are more sensitive to economic conditions and market trends, so it's important to carefully evaluate the location, demand, and potential risks before making an investment. Real estate investment trusts, REITs. Real estate investment trusts, REITs, are investment vehicles that allow individuals to invest in real estate without directly owning properties. REITs pool money from multiple investors to invest in a diversified portfolio of income-generating properties, such as office buildings, shopping centers, and apartment complexes. Investing in REITs offers several advantages. First, it provides a way to invest in real estate with a smaller initial investment compared to purchasing properties directly. REITs also offer liquidity, as they are traded on stock exchanges, allowing investors to buy and sell shares easily. Additionally, REITs are required by law to distribute a significant portion of their income to shareholders in the form of dividends, providing a steady stream of income. However, investing in REITs also comes with its own set of risks. The value of REIT shares can fluctuate based on market conditions, and the income generated by REITs may be subject to taxes. It's important to carefully research and evaluate different REITs before making an investment. Steps to successful real estate investing. Investing in real estate can be a lucrative endeavor, but it requires careful planning and execution. Here are some steps to help you succeed in real estate investing. Educate yourself. Before diving into real estate investing, take the time to educate yourself about the market, different investment strategies, and potential risks. Attend seminars, read books, and consult with experienced investors to gain valuable insights. Set clear goals. Define your financial goals and objectives for real estate investing. Are you looking for long-term appreciation, passive income, or a combination of both? Setting clear goals will help you make informed investment decisions. Create a budget. Determine how much you can afford to invest in real estate. Consider your current financial situation, including your income, expenses, and existing debt. Set a budget that aligns with your financial goals and risk tolerance. Research the market. Conduct thorough market research to identify areas with strong growth potential and high demand for rental properties. Consider factors such as job growth, population trends, and infrastructure development. Analyze potential properties. Once you have identified a target market, analyze potential properties based on their location, condition, rental potential, and potential for appreciation. Consider working with a real estate agent or property manager to help you evaluate properties. Secure financing. Determine the best financing options for your real estate investment. Explore different mortgage options, consider working with private lenders, or explore partnerships with other investors. Ensure that you have a solid understanding of the financing terms and associated costs. Manage properties effectively. If you decide to invest in rental properties, develop a plan for managing them effectively. This includes finding reliable tenants, handling maintenance and repairs, and staying up to date with legal and financial obligations. Monitor and adjust. Regularly monitor the performance of your real estate investments and make adjustments as needed. Stay informed about market trends, rental rates, and potential risks. Consider working with a financial advisor or real estate professional to help you make informed decisions. By following these steps and staying committed to your financial goals, you can build wealth and achieve financial independence through real estate investments. Remember to always conduct thorough research, seek professional advice when needed, and stay informed about market trends and regulations. Retirement accounts and IRAs. Retirement is a significant milestone in life that requires careful planning and preparation. One of the key tools available to individuals for saving for retirement is a retirement account, such as an individual retirement account, IRA. In this section, we will explore the different types of retirement accounts and IRAs, their benefits, and how they can help you achieve financial independence in your golden years. Understanding retirement accounts. Retirement accounts are investment vehicles specifically designed to help individuals save for retirement. These accounts offer tax advantages that can help your savings grow faster over time. There are several types of retirement accounts available, including employer-sponsored plans like 401(k)(s) and 403(b)(s), as well as individual retirement accounts, IRAs. Types of retirement accounts. Employer-sponsored retirement plans. Employer-sponsored retirement plans, such as 401(k)(s) and 403(b)(s), are offered by companies to their employees. These plans allow employees to contribute a portion of their salary to their retirement savings on a pre-tax basis. Some employers also offer matching contributions, where they match a percentage of the employee's contributions, effectively doubling their savings. 401(k)(s) are typically offered by private sector employers, while 403(b)(s) are offered by non-profit organizations, such as schools and hospitals. Both types of plans have contribution limits set by the Internal Revenue Service, IRS, and the funds in these accounts are invested in a variety of investment options, such as mutual funds and target date funds. Individual retirement accounts, IRAs. Individual retirement accounts, IRAs, are retirement accounts that individuals can open on their own. There are two main types of IRAs, traditional IRAs and Roth IRAs. Traditional IRAs allow individuals to contribute pre-tax income, meaning that the contributions are tax-deductible in the year they are made. The funds in a traditional IRA grow tax-deferred, meaning you won't pay taxes on the earnings until you withdraw the money in retirement. However, when you withdraw the funds in retirement, they will be subject to income tax. Roth IRAs, on the other hand, are funded with after-tax income. This means that contributions to a Roth IRA are not tax-deductible. However, the funds in a Roth IRA grow tax-free, and qualified withdrawals in retirement are also tax-free. Roth IRAs offer the advantage of tax-free growth and flexibility in retirement, as there are no required minimum distributions, RMDs, like in traditional IRAs. Benefits of retirement accounts and IRAs. Retirement accounts and IRAs offer several benefits that can help you on your path to financial independence. Tax advantages. One of the primary benefits of retirement accounts and IRAs is the tax advantages they provide. Contributions to traditional retirement accounts are tax-deductible, reducing your taxable income in the year of contribution. This can result in immediate tax savings. Additionally, the funds in these accounts grow tax-deferred, allowing your investments to compound over time without being subject to annual taxes on earnings. Roth IRAs offer tax-free growth, meaning that you won't owe any taxes on the earnings when you withdraw the funds in retirement. This can be particularly advantageous if you expect to be in a higher tax bracket in retirement or if you want to leave a tax-free inheritance to your beneficiaries. Compound growth. Another significant benefit of retirement accounts and IRAs is the power of compound growth. By consistently contributing to your retirement account over time, your investments have the opportunity to grow exponentially. The earlier you start contributing, the more time your investments have to compound and grow. Retirement savings discipline. Having a retirement account or IRA can help instill discipline in your retirement savings. By designating a specific account for your retirement funds, you are less likely to dip into those savings for other purposes. This can help ensure that you have a dedicated pool of funds set aside for your retirement needs. Maximizing your retirement savings. To maximize the benefits of retirement accounts and IRAs, consider the following strategies. Take advantage of employer matching. If your employer offers a matching contribution to your retirement plan, make sure to contribute at least enough to receive the full match. Employer matching is essentially free money that can significantly boost your retirement savings. Contribute regularly and consistently. Consistency is key when it comes to retirement savings. Make it a habit to contribute to your retirement account or IRA regularly, whether it's through automatic payroll deductions or monthly contributions. By contributing consistently, you can take advantage of dollar-cost averaging and smooth out the impact of market fluctuations. Consider a Roth conversion. If you have a traditional IRA, you may want to consider a Roth conversion. A Roth conversion involves converting some or all of your traditional IRA funds into a Roth IRA. While you will owe taxes on the converted amount in the year of conversion, the funds will then grow tax-free in the Roth IRA. This strategy can be particularly beneficial if you expect to be in a higher tax bracket in retirement. Monitoring and adjusting your retirement strategy. As you progress on your path to financial independence, it's essential to regularly monitor and adjust your retirement strategy. Review your retirement account statements, track your progress towards your retirement goals, and make any necessary adjustments to your contributions or investment allocations. Remember, retirement accounts and IRAs are long-term investments, and your strategy may need to evolve over time. Consider consulting with a financial advisor to ensure that your retirement plan aligns with your goals and risk tolerance. By utilizing retirement accounts and IRAs effectively, you can take significant steps towards achieving financial independence and enjoying a comfortable retirement. Start early, contribute consistently, and make informed decisions to make the most of these valuable tools. Chapter 7. Protecting your finances. Insurance basics. Insurance is an essential component of any comprehensive financial plan. It provides protection against unexpected events that could have a significant financial impact on your life. In this section, we will explore the basics of insurance and how it can safeguard your financial well-being. What is insurance? Insurance is a contract between an individual or entity, the policyholder, and an insurance company. The policyholder pays a premium in exchange for financial protection against specific risks. In the event of a covered loss, the insurance company compensates the policyholder according to the terms of the policy. The purpose of insurance is to transfer the risk of financial loss from the individual to the insurance company. By pooling premiums from many policyholders, insurance companies can spread the risk and provide coverage at a more affordable cost. Types of insurance. There are various types of insurance available to protect different aspects of your life. Let's explore some of the most common types. Life insurance. Life insurance provides financial protection to your loved ones in the event of your death. It pays out a death benefit to the beneficiaries named in the policy. There are two primary types of life insurance: term life insurance and permanent life insurance. Term life insurance. This type of insurance provides coverage for a specific period, typically 10, 20, or 30 years. It is more affordable than permanent life insurance and is suitable for individuals who need coverage for a specific period, such as when they have dependents or outstanding debts. Permanent life insurance. Unlike term life insurance, permanent life insurance provides coverage for your entire life. It also includes a cash value component that grows over time. Permanent life insurance can be further divided into whole life insurance, universal life insurance, and variable life insurance. Health insurance. Health insurance is designed to cover medical expenses and provide financial protection against the high costs of healthcare. It helps pay for doctor visits, hospital stays, prescription medications, and other medical services. Health insurance can be obtained through an employer, government programs, or purchased individually. Property insurance. Property insurance protects your physical assets, such as your home, car, or personal belongings, against damage or loss. It provides coverage for events like fire, theft, vandalism, or natural disasters. Property insurance can be further categorized into homeowners insurance, renters insurance, and auto insurance. Homeowners insurance. This type of insurance protects homeowners against damage to their property and liability for injuries or damages that occur on their premises. Renters insurance. Renters insurance provides coverage for tenants' personal belongings and liability for injuries or damages that occur in their rented space. Auto insurance. Auto insurance covers damages or injuries resulting from accidents involving your vehicle. It is mandatory in most states and provides liability coverage, as well as coverage for damages to your vehicle. Disability insurance. Disability insurance provides income replacement if you become unable to work due to an illness or injury. It ensures that you can continue to meet your financial obligations and maintain your standard of living during a period of disability. Long-term care insurance. Long-term care insurance covers the costs associated with long-term care services, such as nursing home care, assisted living, or in-home care. It helps protect your assets and provides financial assistance for the high costs of long-term care. Why is insurance important? Insurance plays a crucial role in protecting your financial well-being. Here are some reasons why insurance is important. Financial protection. Insurance provides a safety net that protects you and your loved ones from financial hardship in the face of unexpected events. It ensures that you have the necessary funds to cover medical expenses, property damage, or loss of income. Peace of mind. Knowing that you have insurance coverage can give you peace of mind. It allows you to focus on other aspects of your life without constantly worrying about the financial consequences of unforeseen events. Risk management. Insurance helps you manage risk by transferring the potential financial burden to an insurance company. It allows you to mitigate the impact of risks and uncertainties, giving you greater control over your financial future. Compliance with legal requirements. Certain types of insurance, such as auto insurance, are mandatory by law. Having the required insurance coverage ensures that you comply with legal requirements and avoid potential penalties or legal issues. Assessing your insurance needs. To determine the appropriate insurance coverage for your needs, it is essential to assess your specific circumstances. Consider the following factors. Your financial obligations. Evaluate your current financial obligations, such as mortgage payments, outstanding debts, or dependents who rely on your income. Ensure that your insurance coverage is sufficient to meet these obligations in the event of your death or disability. Your assets. Assess the value of your assets, including your home, car, personal belongings, and investments. Choose insurance coverage that adequately protects these assets against potential risks. Your health and medical needs. Consider your health condition and medical history when selecting health insurance coverage. Evaluate the level of coverage you need for routine medical expenses, as well as potential major medical events. Your income and earning potential. Assess your income and earning potential to determine the appropriate level of disability insurance coverage. Ensure that it provides adequate income replacement in the event of a disability that prevents you from working. Your long-term care needs. Evaluate your potential long-term care needs based on factors such as age, family medical history, and lifestyle. Consider long-term care insurance if you anticipate the need for such services in the future. Working with an insurance professional. Choosing the right insurance coverage can be complex, given the various options available. Working with an insurance professional, such as an insurance agent or broker, can help you navigate the process and make informed decisions. An insurance professional can assess your needs, recommend appropriate coverage, and provide you with quotes from different insurance companies. They can also explain the terms and conditions of the policies, answer your questions, and assist you in filing claims if necessary. When selecting an insurance professional, ensure that they are licensed, reputable, and have a good understanding of your specific insurance needs. Take the time to compare quotes and policies from different insurance companies to ensure you are getting the best coverage at a competitive price. Remember, insurance is an ongoing process. Regularly review your insurance coverage to ensure it aligns with your changing needs and circumstances. By having the right insurance in place, you can protect your financial well-being and have peace of mind knowing that you are prepared for the unexpected. Health and life insurance. Health and life insurance are essential components of a comprehensive financial plan. They provide protection and peace of mind for you and your loved ones in the face of unexpected events and emergencies. In this section, we will explore the importance of health and life insurance, the different types available, and how to choose the right coverage for your needs. Health insurance. Health insurance is a type of coverage that helps pay for medical expenses, including doctor visits, hospital stays, prescription medications, and preventive care. It is designed to protect you from the high costs of healthcare and ensure that you have access to the necessary medical services when you need them. Why is health insurance important? Health insurance is important for several reasons. Firstly, it provides financial protection against unexpected medical expenses. Without insurance, a serious illness or injury could lead to significant financial hardship. Health insurance helps mitigate these risks by covering a portion of the medical costs, reducing the burden on your finances. Secondly, health insurance promotes regular preventive care and early detection of health issues. With insurance coverage, you are more likely to seek routine checkups, screenings, and vaccinations, which can help prevent or detect diseases at an early stage when they are easier and less expensive to treat. Lastly, having health insurance gives you access to a network of healthcare providers. Insurance plans often have a network of doctors, hospitals, and specialists that you can choose from. This network ensures that you receive quality care and have access to a wide range of medical services. Types of health insurance. There are several types of health insurance plans available, each with its own features and benefits. Here are some common types. Employer-sponsored health insurance. Many employers offer health insurance coverage as part of their employee benefits package. These plans are typically more affordable than individual plans and provide coverage for you and your dependents. Individual health insurance. If you are self-employed or your employer does not offer health insurance, you can purchase an individual health insurance plan. These plans are customizable and allow you to choose the coverage that best suits your needs. Government-sponsored health insurance. In some countries, the government provides health insurance programs for eligible individuals and families. Examples include Medicare and Medicaid in the United States. Health Maintenance Organization (HMO) plans require you to choose a primary care physician (PCP) who coordinates your healthcare. You must get referrals from your PCP to see specialists. HMOs generally have lower out-of-pocket costs but offer less flexibility in choosing healthcare providers. Preferred Provider Organization (PPO) plans offer more flexibility in choosing healthcare providers. You can see specialists without a referral, but you will pay higher out-of-pocket costs for out-of-network care. High Deductible Health Plan (HDHP)s have lower monthly premiums but higher deductibles. They are often paired with a health savings account (HSA), which allows you to save pre-tax dollars for medical expenses. Choosing the right health insurance coverage. When choosing health insurance coverage, consider the following factors. Coverage and benefits. Review the coverage details and benefits offered by different plans. Consider your healthcare needs, including prescription medications, specialist visits, and any ongoing medical conditions. Costs. Compare the monthly premiums, deductibles, co-pays, and out-of-pocket maximums of different plans. Consider your budget and how much you can afford to pay for healthcare expenses. Network. Check the network of doctors, hospitals, and specialists included in each plan. Ensure that your preferred healthcare providers are in network to maximize your coverage. Prescription drug coverage. If you take prescription medications regularly, review the plan's formularies to ensure that your medications are covered. Additional benefits. Some plans offer additional benefits such as dental and vision coverage, wellness programs, and telemedicine services. Consider these extras when comparing plans. It is important to carefully review and understand the terms and conditions of any health insurance plan before enrolling. If you have any questions or need assistance, consult with a licensed insurance professional who can guide you through the process. Life insurance. Life insurance is a contract between an individual and an insurance company, where the insurer promises to pay a designated beneficiary a sum of money upon the insured's death. It is designed to provide financial protection to your loved ones in the event of your passing. Why is life insurance important? Life insurance plays a crucial role in ensuring the financial well-being of your family and dependents after you are gone. Here are some reasons why life insurance is important. Income replacement. If you are the primary breadwinner in your family, life insurance can replace your income and provide financial support to your loved ones in your absence. It can help cover daily living expenses, mortgage payments, education costs, and other financial obligations. Debt repayment. Life insurance can be used to pay off outstanding debts such as mortgages, car loans, and credit card balances. This prevents your loved ones from inheriting your debts and relieves them of the financial burden. Education expenses. Life insurance proceeds can be used to fund your children's education expenses, ensuring that they have the opportunity to pursue their dreams and aspirations. Funeral and final expenses. Life insurance can cover funeral costs, burial expenses, and other end-of-life expenses, relieving your family of the financial burden during a difficult time. Types of life insurance. There are two primary types of life insurance: term life insurance and permanent life insurance. Term life insurance. Term life insurance provides coverage for a specific period, typically 10, 20, or 30 years. It offers a death benefit to your beneficiaries if you pass away during the term of the policy. Term life insurance is generally more affordable and straightforward compared to permanent life insurance. Permanent life insurance. Permanent life insurance provides coverage for your entire lifetime, as long as you pay the premiums. It includes a death benefit and a cash value component that grows over time. Permanent life insurance can be further divided into whole life, universal life, and variable life insurance. Choosing the right life insurance coverage. When selecting life insurance coverage, consider the following factors. Coverage amount. Determine the amount of coverage needed to meet your family's financial needs in your absence. Consider factors such as income replacement, debt repayment, education expenses, and funeral costs. Term length. If you opt for term life insurance, choose a term length that aligns with your financial obligations. For example, if you have young children, you may want coverage until they are financially independent. Premiums. Compare the premiums of different policies and ensure that they fit within your budget. Remember that term life insurance premiums are generally lower than permanent life insurance premiums. Financial strength of the insurer. Research the financial strength and reputation of the insurance company before purchasing a policy. Look for companies with high ratings from independent rating agencies. Additional riders. Riders are optional add-ons to a life insurance policy that provide additional benefits. Examples include accelerated death benefit riders, which allow you to access a portion of the death benefit if you are diagnosed with a terminal illness. It is advisable to review your life insurance coverage periodically to ensure that it aligns with your changing financial needs. As your circumstances evolve, you may need to increase or decrease your coverage accordingly. In conclusion, health and life insurance are crucial components of a well-rounded financial plan. Health insurance protects you from the high costs of medical care, while life insurance provides financial security to your loved ones in the event of your passing. By understanding the different types of coverage available and selecting the right policies for your needs, you can safeguard your financial well-being and achieve peace of mind. Property and auto insurance. Property and auto insurance are essential components of a comprehensive financial plan. They provide protection against unexpected events that could result in significant financial loss. In this section, we will explore the importance of property and auto insurance, the different types of coverage available, and how to choose the right policies for your needs. Understanding property insurance. Property insurance is designed to protect your physical assets, such as your home, rental property, or business premises, from damage or loss. It provides coverage for events like fire, theft, vandalism, and natural disasters. Without property insurance, you would be solely responsible for repairing or replacing your property in the event of such incidents, which can be financially devastating. When considering property insurance, it's important to understand the different types of coverage available. The most common types include homeowners insurance. This type of insurance provides coverage for your primary residence. It typically includes protection for the structure of your home, personal belongings, liability coverage, and additional living expenses if you are temporarily displaced from your home due to a covered event. Renters insurance. If you are renting a property, renters insurance is crucial. It covers your personal belongings and provides liability coverage in case someone is injured while on your rented property. Renters insurance is affordable and offers peace of mind knowing that your possessions are protected. Commercial property insurance. If you own a business, commercial property insurance is necessary to protect your physical assets, such as buildings, equipment, and inventory. It also provides liability coverage for any injuries that may occur on your business premises. When choosing property insurance, it's important to consider the coverage limits, deductibles, and any additional endorsements or riders that may be available. It's also advisable to review your policy annually to ensure it adequately covers your property and any changes in your circumstances. Understanding auto insurance. Auto insurance is a legal requirement in most countries and is designed to protect you financially in the event of an accident or damage to your vehicle. It provides coverage for bodily injury liability, property damage liability, and may also include coverage for medical expenses, uninsured, underinsured motorists, and comprehensive collision coverage. Here are some key components of auto insurance. Liability coverage. This coverage protects you if you are at fault in an accident and cause injury to others or damage to their property. It helps cover the costs of medical bills, property repairs, and legal fees. Collision coverage. Collision coverage pays for repairs or replacement of your vehicle if it is damaged in a collision, regardless of who is at fault. Comprehensive coverage. Comprehensive coverage protects your vehicle against non-collision events such as theft, vandalism, natural disasters, and falling objects. Uninsured, underinsured motorist coverage. This coverage provides protection if you are involved in an accident with a driver who does not have insurance or has insufficient coverage to pay for damages. When selecting auto insurance, it's important to consider factors such as coverage limits, deductibles, and any additional optional coverage that may be available. It's also advisable to compare quotes from multiple insurance providers to ensure you are getting the best coverage at the most competitive price. Choosing the right insurance policies. Choosing the right property and auto insurance policies can be a daunting task, but it's essential to protect your financial well-being. Here are some steps to help you make informed decisions. Assess your needs, evaluate your assets, including your home, vehicles, and personal belongings. Determine the value of these assets and the level of coverage you require to adequately protect them. Research insurance providers. Look for reputable insurance companies with a strong financial rating and a history of excellent customer service. Read reviews and seek recommendations from friends, family, or financial advisors. Compare quotes. Obtain quotes from multiple insurance providers to compare coverage options and premiums. Consider factors such as deductibles, coverage limits, and any additional endorsements or riders that may be available. Review policy details. Carefully review the policy documents, including the terms and conditions, coverage limits, exclusions, and any additional fees or charges. Ensure that the policy meets your specific needs and provides adequate coverage for potential risks. Seek professional advice. If you are unsure about the insurance options or need assistance in understanding the policy details, consider consulting with an insurance agent or financial advisor. They can provide guidance and help you make informed decisions. Regularly review and update as your circumstances change, such as acquiring new assets or making renovations to your property. It's important to review and update your insurance policies accordingly. Regularly reassess your coverage needs to ensure you are adequately protected. Remember, insurance is not just a legal requirement, it is a crucial component of your financial plan. By having the right property and auto insurance policies in place, you can protect yourself from unexpected financial burdens and have peace of mind knowing that you are prepared for any unforeseen events. Identity theft protection. Identity theft is a growing concern in today's digital age. With the increasing reliance on technology and the internet, it has become easier for criminals to steal personal information and use it for fraudulent purposes. As a result, protecting your identity has become an essential part of maintaining your financial security. In this section, we will discuss the steps you can take to protect yourself from identity theft and safeguard your financial well-being. Understanding identity theft. Identity theft occurs when someone steals your personal information, such as your name, social security number, or credit card details, and uses it without your permission. This stolen information can be used to open new accounts, make unauthorized purchases, or even commit crimes in your name. The consequences of identity theft can be devastating, leading to financial loss, damaged credit, and a significant amount of time and effort to resolve the issue. Safeguarding personal information. One of the first steps in protecting yourself from identity theft is to safeguard your personal information. Here are some essential practices to follow. Secure your documents. Keep important documents, such as your social security card, birth certificate, and financial statements, in a secure location, preferably a locked safe or a safety deposit box. When disposing of sensitive documents, shred them to prevent dumpster divers from accessing your information. Be cautious online. Be mindful of the information you share online, especially on social media platforms. Avoid posting personal details such as your full name, address, phone number, or birth date. Additionally, be cautious when clicking on links or downloading attachments from unknown sources, as they may contain malware designed to steal your information. Use strong passwords. Create strong, unique passwords for your online accounts and change them regularly. Avoid using easily guessable passwords such as your birthdate or 1234556. Consider using a password manager to securely store and generate complex passwords. Protect your devices. Install reputable antivirus software on your computer and mobile devices to protect against malware and viruses. Keep your operating system and applications up to date with the latest security patches. Enable two-factor authentication whenever possible to add an extra layer of security to your accounts. Monitoring your financial accounts. Regularly monitoring your financial accounts is crucial in detecting any suspicious activity and addressing it promptly. Here are some steps you can take to monitor your accounts effectively. Review your bank and credit card statements. Take the time to review your bank and credit card statements regularly. Look for any unfamiliar transactions or charges and report them to your financial institution immediately. Check your credit reports. Request a free copy of your credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, annually. Review the reports for any inaccuracies or accounts that you don't recognize. If you find any discrepancies, report them to the credit bureau and the respective creditor. Consider credit monitoring services. Credit monitoring services can provide you with real-time alerts whenever there are changes to your credit report or suspicious activity on your accounts. While these services come at a cost, they can provide an added layer of protection and peace of mind. Protecting your social security number. Your social security number, SSN, is a valuable piece of information that identity thieves often target. Here are some steps to protect your SSN. Minimize its use. Only provide your SSN when absolutely necessary, such as for employment, tax purposes, or opening financial accounts. Be cautious when asked for your SSN and inquire about alternative identification methods if possible. Securely store your SSN card. Avoid carrying your SSN card in your wallet or purse unless necessary. Instead, keep it in a secure location with your other important documents. Be cautious of phishing scams. Be wary of unsolicited phone calls, emails, or text messages asking for your SSN or other personal information. Legitimate organizations will not request sensitive information through these channels. If in doubt, contact the organization directly using their official contact information. Responding to identity theft. Despite taking precautions, there is still a possibility of falling victim to identity theft. If you suspect that your identity has been stolen, it is crucial to act quickly. Here are the steps to take. Contact the authorities. Report the identity theft to your local law enforcement agency. Provide them with all the relevant information and any evidence you have. Notify your financial institutions. Contact your bank, credit card companies, and any other financial institutions where you have accounts. Inform them about the identity theft and request that they freeze or close the affected accounts. Place a fraud alert. Contact one of the 3 major credit bureaus and request a fraud alert be placed on your credit report. This alert will notify potential creditors to take extra precautions when verifying your identity. File a complaint with the FTC. Visit the Federal Trade Commission's website and file a complaint about the identity theft. The FTC provides resources and guidance on how to recover from identity theft. Monitor your credit and accounts. Continue monitoring your credit reports and financial accounts for any further signs of fraudulent activity. Consider enrolling in an identity theft protection service for added support. By following these steps and remaining vigilant, you can significantly reduce the risk of falling victim to identity theft. Protecting your personal information and monitoring your financial accounts are essential habits to develop on your path to financial independence. Remember, prevention is key, but being prepared and knowing how to respond in case of identity theft is equally important. Chapter 8. Achieving Financial Independence. Creating multiple streams of income. In today's fast-paced and ever-changing world, relying solely on a single source of income is no longer enough to achieve financial independence. Creating multiple streams of income is a crucial step towards building wealth and achieving financial freedom. By diversifying your income sources, you not only increase your earning potential but also create a safety net that can protect you during economic downturns or unexpected financial challenges. Why multiple streams of income? Having multiple streams of income provides several benefits that can significantly impact your financial well-being. Here are a few reasons why creating multiple income streams is essential. Increased earning potential. By diversifying your income sources, you have the opportunity to earn more money. Each additional stream of income adds to your overall earning potential, allowing you to increase your savings, invest more, and accelerate your journey towards financial independence. Risk reduction. Relying on a single source of income can be risky. If that source is lost or significantly reduced, it can have a devastating impact on your financial stability. By diversifying your income, you spread the risk across different sources, reducing the impact of any single loss. Flexibility and adaptability. Multiple income streams provide you with flexibility and adaptability in your financial life. If one stream of income becomes less profitable or no longer aligns with your goals, you can rely on other sources to maintain your financial stability. This flexibility allows you to explore new opportunities and adapt to changing market conditions. Opportunity for growth. Creating multiple streams of income opens up opportunities for personal and professional growth. Each income stream can be a stepping stone towards new ventures, investments, or business opportunities. It allows you to diversify your skills and knowledge, expanding your horizons and increasing your potential for success. Types of income streams. When it comes to creating multiple streams of income, there are various options to consider. Here are some common types of income streams that you can explore. Employment income. This is the most traditional and common source of income for many individuals. It includes salaries, wages, and bonuses earned from working for an employer. While employment income provides stability, it is essential to diversify beyond this single source. Side businesses. Starting a side business or freelancing can be an excellent way to generate additional income. It could be anything from offering consulting services, selling products online, or providing specialized skills on a freelance basis. Side businesses allow you to leverage your expertise and passion to create an additional income stream. Investment income. Investing in stocks, bonds, real estate, or other investment vehicles can generate passive income. Dividends, interest, rental income, and capital gains are examples of investment income. Building a well-diversified investment portfolio can provide a steady stream of income over time. Rental income. If you own property, renting it out can be a lucrative source of income. Whether it's residential or commercial property, becoming a landlord allows you to earn regular rental income. However, it requires careful management and maintenance of the property. Royalties and licensing. If you have creative talents or intellectual property, you can earn income through royalties and licensing agreements. This could include royalties from books, music, patents, or trademarks. Licensing your ideas or products to others can generate ongoing income without significant ongoing effort. Passive income. Passive income refers to income that requires minimal effort or time once established. Examples include income from affiliate marketing, online courses, e-books, or digital products. Building passive income streams can provide financial stability and freedom. Strategies for creating multiple streams of income. Creating multiple streams of income requires careful planning and execution. Here are some strategies to help you get started. Identify your skills and passions. Start by identifying your skills, expertise, and passions. Look for opportunities to monetize these areas through side businesses, freelancing, or consulting. Leveraging your strengths will increase your chances of success and enjoyment in your additional income streams. Diversify your investments. Invest in a variety of assets to generate investment income. This could include stocks, bonds, real estate, mutual funds, or exchange-traded funds, ETFs. Diversification helps spread the risk and ensures that you have multiple sources of income from your investments. Automate and systematize. To manage multiple income streams effectively, it's crucial to automate and systematize your processes. Use technology and tools to streamline your operations, manage finances, and track income and expenses. This will free up your time and allow you to focus on growing your income streams. Continuously learn and adapt. Stay updated with market trends, new technologies, and emerging opportunities. Continuously invest in your knowledge and skills to stay ahead in your chosen income streams. Be open to adapting your strategies as needed to maximize your earning potential. Network and collaborate. Building a strong network and collaborating with others can open doors to new income opportunities. Attend industry events, join professional associations, and connect with like-minded individuals. Collaborating with others can lead to joint ventures, partnerships, and shared income streams. Monitor and evaluate. Regularly monitor and evaluate the performance of your income streams. Identify which streams are most profitable and align with your long-term goals. Consider scaling up successful income streams and eliminating or adjusting those that are not performing well. Conclusion. Creating multiple streams of income is a powerful strategy for achieving financial independence. By diversifying your income sources, you increase your earning potential, reduce risk, and create flexibility in your financial life. Explore different types of income streams, leverage your skills and passions, and continuously adapt to market trends. With careful planning and execution, you can build a strong foundation for long-term wealth and achieve financial independence. Building a strong financial foundation. Building a strong financial foundation is essential on the path to financial independence. It involves developing a solid understanding of personal finance, establishing healthy financial habits, and making informed decisions about money. By taking the necessary steps to build a strong financial foundation, you can set yourself up for long-term financial success. In this section, we will explore some key steps to help you build a strong financial foundation. Assessing your current financial situation. Before you can build a strong financial foundation, it is important to assess your current financial situation. This involves taking a close look at your income, expenses, assets, and liabilities. By understanding your financial standing, you can identify areas for improvement and develop a plan to achieve your financial goals. Start by creating a comprehensive list of your income sources, including your salary, investments, and any other sources of income. Next, make a list of all your expenses, including fixed expenses like rent or mortgage payments, utilities, and insurance, as well as variable expenses like groceries, entertainment, and transportation. This will give you a clear picture of where your money is going each month. Once you have a clear understanding of your income and expenses, calculate your net worth by subtracting your liabilities, such as credit card debt, student loans, and mortgages, from your assets, such as savings, investments, and property. This will give you an idea of your overall financial health and help you identify areas where you can make improvements. Creating a budget. Creating a budget is a crucial step in building a strong financial foundation. A budget helps you track your income and expenses, prioritize your spending, and ensure that you are living within your means. It allows you to allocate your money towards your financial goals and helps you make informed decisions about your spending. To create a budget, start by listing all your sources of income and then categorize your expenses into different categories such as housing, transportation, groceries, entertainment, and savings. Assign a specific amount to each category based on your income and financial goals. Be sure to allocate a portion of your income towards savings and investments to build wealth over time. Once you have created your budget, track your expenses regularly to ensure that you are sticking to your plan. Use budgeting tools or apps to help you monitor your spending and make adjustments as needed. Remember, a budget is a flexible tool that can be adjusted as your financial situation changes. Building an emergency fund. Building an emergency fund is an important part of building a strong financial foundation. An emergency fund is a savings account specifically set aside to cover unexpected expenses or financial emergencies. It provides a safety net and helps you avoid going into debt when unexpected expenses arise. To build an emergency fund, start by setting a savings goal. Aim to save at least 3 to 6 months' worth of living expenses. This will provide you with a cushion in case of job loss, medical emergencies, or other unexpected events. Set up automatic transfers from your checking account to your emergency fund to make saving a consistent habit. Managing debt. Managing debt is another crucial aspect of building a strong financial foundation. High levels of debt can hinder your financial progress and make it difficult to achieve financial independence. It is important to develop a plan to pay off debt and avoid accumulating more debt in the future. Start by making a list of all your debts, including credit card balances, student loans, and any other outstanding loans. Prioritize your debts based on interest rates and start paying off the highest interest rate debt first while making minimum payments on the others. Consider strategies such as the debt snowball or debt avalanche method to accelerate your debt repayment. In addition to paying off debt, it is important to avoid accumulating more debt. Develop healthy financial habits such as living within your means, avoiding unnecessary purchases, and using credit responsibly. By managing your debt effectively, you can free up more money to save, invest, and work towards your financial goals. Establishing an investment strategy. Building a strong financial foundation also involves establishing an investment strategy. Investing allows you to grow your wealth over time and achieve long-term financial goals such as retirement. It is important to develop a well-diversified investment portfolio that aligns with your risk tolerance and financial goals. Start by educating yourself about different types of investments, such as stocks, bonds, mutual funds, and real estate. Consider working with a financial advisor who can help you develop an investment strategy based on your individual circumstances and goals. Regularly review and adjust your investment portfolio to ensure it remains aligned with your objectives. Remember, investing involves risk, and it is important to diversify your investments to minimize risk. Diversification involves spreading your investments across different asset classes and sectors to reduce the impact of any single investment on your overall portfolio. By establishing an investment strategy and sticking to it, you can build wealth over time and work towards financial independence. Continuously educating yourself. Building a strong financial foundation is an ongoing process that requires continuous education and learning. Stay informed about personal finance topics, investment strategies, and changes in the financial landscape. Read books, attend seminars, and follow reputable financial websites and blogs to expand your knowledge. Additionally, consider seeking guidance from financial professionals who can provide personalized advice based on your unique circumstances. A financial advisor can help you navigate complex financial decisions, develop a comprehensive financial plan, and stay on track towards your financial goals. By continuously educating yourself and staying informed, you can make informed financial decisions, adapt to changes in the financial landscape, and build a strong financial foundation that will support your journey towards financial independence. Conclusion: building a strong financial foundation is a critical step towards achieving financial independence. By assessing your current financial situation, creating a budget, building an emergency fund, managing debt, establishing an investment strategy, and continuously educating yourself, you can set yourself up for long-term financial success. Remember, building a strong financial foundation takes time and discipline, but the rewards are well worth the effort. Start taking steps today to secure your financial future and embark on the path to financial independence. Long-term wealth strategies. Achieving long-term wealth and financial independence requires careful planning, discipline, and a solid understanding of personal finance. In this section, we will explore some key strategies that can help you build wealth over time and ultimately achieve financial independence. Set clear financial goals. Setting clear financial goals is the first step towards long-term wealth creation. Take some time to think about what you want to achieve financially in the future. Do you want to retire early? Buy a home? Start a business? By setting specific and measurable goals, you can create a roadmap for your financial journey. Create a diversified investment portfolio. One of the most effective ways to build long-term wealth is through investing. However, it's important to diversify your investment portfolio to minimize risk. Diversification involves spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities. This helps to protect your portfolio from the volatility of any single investment. Take advantage of compound interest. Compound interest is a powerful tool for building long-term wealth. It allows your investments to grow exponentially over time. By reinvesting the interest or dividends earned on your investments, you can accelerate the growth of your wealth. Start investing early and let the power of compound interest work in your favor. Invest in real estate. Real estate can be a lucrative long-term investment strategy. Whether it's residential properties, commercial properties, or real estate investment trusts, REITs, real estate has the potential to generate passive income and appreciate in value over time. Consider diversifying your investment portfolio by including real estate assets. Maximize retirement contributions. Saving for retirement is crucial for long-term financial independence. Take advantage of retirement accounts such as 401(k)s or IRAs and contribute the maximum amount allowed. These accounts offer tax advantages and can help you grow your retirement savings faster. Start early and consistently contribute to your retirement accounts to ensure a comfortable retirement. Continuously educate yourself. Financial markets and investment strategies are constantly evolving. To stay ahead and make informed decisions, it's important to continuously educate yourself about personal finance and investment opportunities. Read books, attend seminars, and follow reputable financial news sources to expand your knowledge and make better financial decisions. Minimize debt and manage expenses. To build long-term wealth, it's essential to minimize debt and manage your expenses effectively. Pay off high-interest debts as soon as possible and avoid unnecessary expenses. Create a budget and track your spending to identify areas where you can cut back. By reducing debt and managing expenses, you can free up more money to invest and grow your wealth. Seek professional financial advice. While it's important to educate yourself about personal finance, seeking professional financial advice can provide valuable insights and guidance. A financial advisor can help you create a personalized financial plan, assess your risk tolerance, and recommend investment strategies that align with your goals. Consider working with a trusted financial advisor to optimize your long-term wealth-building efforts. Stay disciplined and patient. Building long-term wealth requires discipline and patience. It's important to stay committed to your financial goals and stick to your investment plan, even during market downturns. Avoid making impulsive investment decisions based on short-term market fluctuations. Stay focused on your long-term objectives and trust in the power of compounding and time. Review and adjust your strategy regularly. As your financial situation and goals evolve, it's crucial to review and adjust your wealth-building strategy regularly. Monitor the performance of your investments, reassess your risk tolerance, and make necessary adjustments to your portfolio. Regularly reviewing and updating your strategy will ensure that you stay on track towards achieving long-term financial independence. By implementing these long-term wealth strategies and staying committed to your financial goals, you can pave the way to financial independence. Remember, building wealth takes time and effort, but with the right mindset and strategies, you can create a secure and prosperous financial future. Financial independence and early retirement. Financial independence is a goal that many people aspire to achieve. It is the state of having enough wealth and resources to sustain your desired lifestyle without the need to work actively for income. Achieving financial independence allows you to have more control over your time and pursue your passions and interests. Early retirement, on the other hand, refers to the ability to retire from traditional employment at a younger age than the average retirement age. Understanding financial independence. Financial independence is not about being rich or having a high income. It is about managing your finances in a way that allows you to live comfortably and sustainably without relying on a paycheck. To achieve financial independence, you need to focus on building wealth, reducing debt, and creating multiple streams of income. Building wealth. Building wealth is a crucial step towards financial independence. It involves saving and investing your money wisely to grow your assets over time. One of the most effective ways to build wealth is through long-term investments such as stocks, bonds, and real estate. These investments have the potential to generate passive income and appreciate in value over time. Reducing debt. Debt can be a major obstacle to achieving financial independence. High-interest debt, such as credit card debt or personal loans, can eat into your income and make it difficult to save and invest. It is important to prioritize paying off your debts and avoid taking on unnecessary debt. Creating a debt repayment plan and sticking to it can help you become debt-free faster. Creating multiple streams of income. Relying solely on a single source of income can be risky and limit your financial independence. Creating multiple streams of income diversifies your sources of revenue and provides a safety net in case one income stream dries up. Some ways to create additional income streams include starting a side business, investing in rental properties, or generating passive income through investments. Steps to achieve financial independence. Achieving financial independence requires careful planning and disciplined financial habits. Here are some steps you can take to work towards financial independence and early retirement. Step 1. Set clear financial goals. To achieve financial independence, you need to have a clear vision of what you want to accomplish. Set specific, measurable, achievable, relevant, and time-bound, SMART, financial goals. These goals will serve as your roadmap and help you stay focused on your journey towards financial independence. Step 2. Create a budget and stick to it. A budget is a crucial tool for managing your finances and tracking your progress towards financial independence. It helps you allocate your income towards savings, investments, and essential expenses while minimizing unnecessary spending. Regularly review and adjust your budget to ensure it aligns with your financial goals. Step 3. Save and invest wisely. Saving and investing are key components of building wealth and achieving financial independence. Aim to save a portion of your income each month and invest it in assets that have the potential to grow over time. Consider diversifying your investments to reduce risk and maximize returns. Step 4. Minimize expenses and live below your means. Living below your means is essential for achieving financial independence. Minimize your expenses by cutting unnecessary costs and adopting a frugal lifestyle. Differentiate between wants and needs and prioritize spending on things that truly align with your values and goals. Step 5. Maximize your income potential. Increasing your income can accelerate your journey towards financial independence. Look for opportunities to advance in your career, acquire new skills, or start a side business. Consider investing in your education or seeking additional certifications to enhance your earning potential. Step 6. Continuously educate yourself. Financial literacy is crucial for achieving and maintaining financial independence. Continuously educate yourself about personal finance, investing, and wealth-building strategies. Stay updated on market trends and seek advice from financial professionals when needed. Step 7. Monitor and adjust your plan. Regularly monitor your progress towards financial independence and make adjustments as needed. Review your investments, track your expenses, and reassess your financial goals. Stay flexible and adapt your plan to changing circumstances and market conditions. Benefits of financial independence and early retirement. Achieving financial independence and early retirement can have numerous benefits, including freedom to pursue your passions and interests without the constraints of traditional employment, more time to spend with family and loved ones, reduced stress and improved mental well-being, ability to travel and explore new experiences, opportunity to give back to your community through volunteering or philanthropy, increased flexibility and control over your time and lifestyle choices. Financial independence and early retirement are not easy to achieve, but with careful planning, discipline, and a long-term perspective, they are within reach for many individuals. Start taking steps towards financial independence today and enjoy the benefits of a life free from financial worries. As we close the final chapter of Wealth Mastery, a comprehensive guide to achieving financial independence, we reflect on the journey we've undertaken together. Written and published by Mindful Literary, this guide has been your companion through the complexities of personal finance, from the foundational aspects of budgeting and saving to the strategic considerations of investing and wealth building. Throughout this book, we've explored various facets of financial literacy, emphasizing the power of informed decision-making and strategic planning. Our goal has been to equip you with the tools and knowledge necessary to navigate your financial journey with confidence and clarity. Remember, the journey toward financial independence is both personal and perpetual. The principles and strategies discussed are not merely steps to be checked off, but practices to be integrated into your daily life. As you move forward, continue to educate yourself, stay adaptable to change, and remain committed to your financial goals. We encourage you to revisit the chapters of Wealth Mastery whenever you seek guidance, motivation, or a refresher on the path to financial success. Your journey doesn't end here, it evolves. With each decision, you're not just managing money, you're shaping your future. Thank you for embarking on this journey with us. May the insights from Wealth Mastery inspire you to pursue your dreams with determination and achieve the financial independence you deserve. Here's to mastering your wealth and unlocking a future brimming with possibilities. Written and published by Mindful Literary.